timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Beginning Q2 in positive territory on the S&P. Positive by 0.1%. Right now on the Nasdaq 100 up by about 0.2. On the Russell up by about 1/3%. Just a little bit of outperformance there. It was bigger earlier in the session. I want to turn to the bond market. Peter Cheer's got thoughts. I can tell you about the long end of the curve. Up 4 basis points this morning, 423.78. Pete, you've got to tell me, your theory is, the big thesis, later this year supply reasserts itself. Why?
You know, I think we go back to all the stories that drove us to 5%, right? Supplies there, dysfunction in DC, foreign buying smaller, Japan's finally easing. It was the most hawkish. It was the most dovish, hawkish move ever. But you see all those things playing together, and I think commodities are going to continue to be a good story. And we haven't talked about it yet today, but when you start looking at all the things that are going on, not just with EV, but AI, the energy usage is actually increasing in this country. It's probably the first time that, in quite a while, that we've had, on a national basis, energy increases in demand, and it's largely EVs, AI-related, the data centers. I think that's going to be a continuing story. So if you get that sort of inflationary pressure at a base level, I think that's going to push on yields, and I don't see that changing. So the front end's going to be controlled by the Fed, so I think steeper yield curves are, I guess, at this point, less inverted. I'd like to see 2s10s get back to 0.
Hold on a minute. Let me get into that, because you mentioned a lot. AI, which a lot of people would say is great for productivity, you're saying it's going to be really bullish for energy, and that's going to be producing high yields. Can you just develop that a little bit further?
Yeah, so the amount of energy being consumed by these data centers is very high. If you look, Amazon bought a facility that's powered by a nuclear generator. There's a lot of shifts where people are looking to locate these data centers where cheap energy is. So I think you might see some geographic shifts where people do business, how it's all going to be managed. But the amount of data that's being processed and used is growing exponentially with AI. That's creating this huge demand for utilities and energy away from oil, et cetera. EV, same sort of thing, right? As that market grows, it's been slowing, but it's still a growing market. You're going to have more and more demand for electricity. I think that's going to push energy prices higher across this country. And again, most of our energy is still, traditional sources, so it's great for all the commodities. That is going to be the downside of AI, at least in the near term. And unlike, say, crypto, where some people talked about the same sort of issue with crypto, crypto could go global. I think people are so much more aware of the risk of having your data center not in the US or Canada, someplace that you can trust, that you're not going to be that shift. You're not going to see data centers pop up all over the globe because people are becoming more and more concerned. Why is my data in that country? Do I trust it in that country? I want it domiciled here. So I think that story of national security data centers helps the energy market a lot.
Okay, so what do I want to own?
Again, I think you want to own a bunch of the commodities. You want to own the hard commodities. You want to own the energy. We are in the midst of this kind of rebuilding our society, how it changes. A lot's going to be domestic. I think that's going to create a underlying inflation pressure, not huge, but there is going to be that
Okay.
inflation pressure, and that's what you want to own as we kind of become more independent again across the board.
Nothing happening in foreign exchange can rival this conversation we've just had, but I'll check in on the euro for you. The euro against the dollar, 107.80, negative about 0.1%. Heard from the Austrian central bank governor a little bit earlier over in Europe, talking about the ECB going before the Federal Reserve and saying the European economy is growing at a slower pace than the US. That could mean that our price dynamic weakens more. I think that basically is in line with consensus going through 2024. Under surveillance this morning, the US and Israel set to meet virtually today to discuss the Biden administration's alternative proposals to an invasion of Rafah, according to Axios. The meeting following comments from Israeli Prime Minister Benjamin Netanyahu saying they're preparing to move more than 1 million Palestinian civilians out of Rafah before launching an attack on the southern Gaza city. I want to talk to you about what the generals at Academy are telling you about this, Pete. What are they saying?
So I think right from day one, we said this was going to be a very difficult thing. And our generals compared this Fallujah, which was a very difficult battle for us to win. And we had it much easier because the civilians had already been taken away. So you knew that most of the people there were hostile combatants. And unlike you've seen in Gaza, there was not the tunnel system. So none of this, unfortunately, is surprising that it is that difficult. I think it's probably a good step if they can move the civilians out. But if Israel is intent on destroying these as fighting forces, it's going to be a long and probably brutal process, unfortunately.
Well, that's what I wanted to ask you, what these generals are talking about. If they're able to remove the civilians, which pretty much Biden has made that at least a condition, a red line condition for Israel to go into Rafah, how long until Israel can say, it's victory, we've gotten rid of Hamas?
You know, I think when we talk about it, you can maybe do bombs, you can do things, but the only way to know whether you've cleared it is you literally have to go door to door, kicking in doors, checking out, is this house clear, and block by block. So it is a very slow process, especially if you have tunnels and things like that, so people can shift around. So it is not going to be easy. Even once you think maybe victory is achieved, it will potentially take months to go through and truly clear it out. So any hope that this is going to be a short-term resolution or in quickly and solved, I think is out of place. So that's why we think this is lasting longer, and one reason I remain so worried that we are going to eventually drag Iran into this, and that is going to really jack the prices of oil higher.
That a risk or a base case?
For me, I think it's almost a base case. It just feels that, again, you've watched what's going on with the Houthis, right? They have been very successful. We've launched attacks against them, but they are still attacking shipping, right? They have become very good at what they do. They take relatively, unsophisticated weaponry, they move it around, they hide, they launch, they disappear, and we're spending $1 million missiles trying to shoot down $10,000 drones. It's not a very economic process, and they're very good at this. So unless something changes that we strike fear back into these countries, or these proxies,
sure,
this continues, unfortunately.
So what does that look like? Just sort of build that out for us a little bit more. A continuation of what we're seeing, tension with proxies, or their direct involvement?
I think it continues tensions with proxies, and we would like to keep it that way, I think, as long as possible. Again, Iran's only selling 3.5 million barrels a day, but that is a significant part of the keeping oil prices lower, right? If you take that down to 1 million, probably oil goes back above 100. So no one wants that coming into election year. So I think everyone, again, is like, let's keep this to proxies and play it even if we really know there's more involvement.
Fascinating. Fascinating. Let's turn to our next story. A busy week of Fed data, Fed speak and data for the Fed. Commentary from the Fed every single day this week, including Chairman Powell on Wednesday. ADP employment data also coming that day. Another round of jobless claims on Thursday, followed by the main event, payrolls on Friday. Greg Dacko of EY saying this: overall, the US economy is gently decelerating due to more scrutinous consumers and business leaders in a high cost and high interest rate environment. Inflation stickiness is a risk, but not our base case. Greg joins us now for more. Greg, what's interesting about this, and good morning to you, sort of runs counter to what we heard from Bill Dudley about 10 minutes or so ago. You think we are sufficiently restrictive? You think we are on that glide path towards 2% inflation? Why is that?
Well, I think we are seeing some signs of deceleration, especially in the labor market. It may not be the retrenchment that was once feared, the fear of a recession, a rapid rise in the unemployment rate, but we are seeing labor demand ease, whether it's the quits rate or the hiring rate, whether it's the pace of job growth. With the revisions last month, we were talking a month ago about the potential noisiness in the data. We saw it in the revisions. We are seeing also wage growth momentum easing. All of those factors point to a gently easing U.S. economy that puts more pressure on consumers when it comes to spending.
So what would you do? Would you cut in May, cut in June, not cut?
Well, I said last month that I was a May guy. I think it's more likely now that we're going to see the Fed ease in June. I think given what we saw in the March economic projections, in the March dot plot, we have a number of policymakers that are still leaning on the hawkish side. We know that the dot plot was very close to essentially moving back to 2 rate cuts over the course of this year. We think that the onset will be in June, that there might be actually some signaling in the policy statement from a negative policy statement saying that the committee will not consider easing monetary policy before to saying the policy committee will start to ease once it sees sufficient confidence that we're moving in the right direction.
Yeah, and that's interesting because, one, I always like to be a contrarian. The start of the year seemed easy, right? They were pricing in 6 or 7 cuts. Now we're down to this 2, 3. I'm kind of torn. Which is wrong? Is it going to be fewer or more? Or do we have it right for a change?
I think the volatility is very interesting to note because we are in an environment where we're seeing that every data release is scrutinized with too much attention, in my opinion. And the noisiness in the data that we saw both in January and in February, some echoes of the January volatility in the data, means that there are rapid repricing that are happening on a day-to-day basis. That is not a normal environment. What we should see is as the data starts to stabilize, we're going to see markets and the Fed realign towards a more gradual easing of monetary policy. And I still would expect about 3 rate cuts over the course of this year. I don't buy the story that inflation is entrenched, nor the story that the economy is reaccelerating and that is going to feed into higher inflationary pressures.
One place where it's not noise and it's real is the rise in commodity prices. How much can that hurt the Fed and as they try to, have this soft landing?
Well, in the past, we used to say that commodities prices were transitory, right? But that's become a bad word. So we are in an environment where because inflation is higher than the Fed's objective of 2%, we are seeing these pressures on the commodities price front lead to potentially some tighter Fed policy down the road. It's not just the Fed, it's the ECB, it's the Bank of Canada, it's other central banks around the world that are affected by these higher commodities prices because they put higher pressure on inflation. So if we are to see an environment where commodities prices generally continue to push up, that will lead to higher energy price inflation and will lead to higher headline inflation, which is going to be a key concern for the Fed that is still keenly focused on getting inflation sustainably, and that's the important word, sustainably, down to 2%.
Some people don't buy that after Chairman Powell's performance in the news conference, so I'd love your thoughts on that because I imagine they run counter to that conclusion. Some people believe that maybe this Fed's willing to tolerate higher inflation, which is why we had gold running across the bottom of the screen at all-time highs, while there is this conversation about maybe gold going even higher and starting to price in maybe 3% inflation for a little bit longer. This is what Pete's been talking about in the last hour. Why are those people, including Pete, why are they wrong?
Well, I don't think it's being wrong. I think the starting conditions, as you were saying earlier, are very important. We are coming from above the 2% target when it comes to inflation. So yes, it is true that we will see more time before we get back down towards that 2% target. But because we are starting from above that target, and because monetary policy is fairly restrictive at this stage, this environment where you're seeing moderating economic growth, more pricing sensitivity, less pricing power, does invite the Fed to gradually ease monetary policy. Not do so very rapidly, but gradually do so and focus on core inflation, which has been a key focus of the Fed. We're seeing core inflation move down towards 2.5%, which has been this key pillar of attention for Fed policymakers, and I think we will continue to do so as the economy gently cools.
In terms of surprises, one thing I see is the market seems to view that the slowing Chinese economy might be very good and provide deflation. What I don't think gets talked enough about is India's rapid rise and the potential for an inflation or commodity type boom there. What surprises do you see either that would create a big, inflation spike or deflationary?
I think we have to distinguish the cyclical inflation developments from the structural inflation developments. From a cyclical perspective, we are seeing slowing growth in the U.S. We're also seeing fairly moderate growth across the globe. That is disinflationary in the short term. In the longer run, we have some factors that are likely to be more inflationary. We have an environment that is deglobalizing. We're seeing supply chain shocks, just like we saw in Baltimore. These types of events in the past might not have that big of a consequence, but add them to the Suez issue, the Red Sea issue, the Panama Canal issue, and you have all the regular ingredients that push up structural inflation, the aging of the population, Gen AI and capital investment that's going in there. Those are all inflationary, will likely lift inflation over the 2% target, which is one reason why I think the Fed may consider adding a band around that 2% target, because 2% might be too precise. We might need a band to have that wiggle room in terms of monetary policy.
What kind of band are you talking about? 2.5 or 3%?
Well, we don't know, but the Fed is going to be implementing its new revision of its new framework. The framework that was put in place right before the COVID crisis was perhaps done so at the worst possible time. But we are likely to see, I think, some kind of wiggle room, perhaps 1%, around 2%, so from 1.5% to 2.5%, which would offer more flexibility for policymakers.
I've got to ask the question, if they do that, does it make it even harder to hit 2? If they start to entertain the notion that maybe they'd overshoot by 100 basis points, does it make it harder to get down to 2?
Of course, you don't want to be moving the goal line or the goalpost closer when you're losing by 10-0.
Yeah.
But you do want to consider that once you have achieved at least some form of being close to that 2% target. So that's why I think this is not a story for 2024. This is a story for 2025. Once we are, at the end of this year, closer to that Fed target of around 2%.
Interesting. Greg, thoughtful stuff. It's good to see you as always. Thank you. Greg Dacker there of EY. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. AT&T down in pre-market trading after the telecom giant said the data of more than 70 million current and former customers was leaked onto the dark web. This includes personal information such as social security numbers. AT&T says the source of the data is still being investigated, and it's not known whether it came from the company or a vendor. It's not the first issue this year for AT&T. Back in February, it experienced a widespread outage that took hours to resolve and is now being investigated by the federal government. In the March Madness tournament, the North Carolina State men's team continuing their shocking run with a win over Duke Sunday night. The 76-64 victory has the 11th-seeded Wolfpack back in the Final Four for the first time since it won the national championship in 1983. And in the women's tournament, college superstars Caitlin Clark of Iowa and Angel Reese of LSU face off tonight in a rematch of last year's national championship game. Formula One owner Liberty Media will buy Motorcycle Racing League MotoGP World Championship in a $3.8 billion deal. Liberty takes control of the league by buying exclusive rights holder Dorna Sports from Bridgepoint and Canada Pension Plan Investment Board. The deal may draw scrutiny from antitrust regulators, given it'll merge two influential sports racing businesses. Liberty said it's funding the deal with a mix of cash and debt and expects the transaction to close by the end of this year. That's your Bloomberg Brief. John?
So basically, we're going to get another Netflix show, but this time it's about MotoGP, right?
Potentially. What I find interesting is that Liberty will not be the first company to actually own them both. A private equity firm actually owned both of them first, MotoGP and F1. And guess what? The EU anti-regulator said, you have to break it up.
Let's see if it's different this time. Up next on this program, the balancing act for Chair Powell.
Right now, there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. And my personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer.
That conversation up next.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it?
Peacock, yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
The opening bow, the first trading day of Q2, 42 minutes away. Equity futures right now positive by 0.1%, by 0.14% on the S&P 500. Yields climbing higher by 3 or 4 basis points, 423.59. Under surveillance this morning, the balancing act for Chair Powell.
Right now, there's a bit of a battle going on. The long legs of monetary policy versus the easing of financial conditions. And my personal opinion is monetary policy is not really exerting that much restraint on the economy. And that's why the Fed has been on this path of having to stay higher for longer. The Fed thinks that the federal funds rates can go all the way back to 2.6%. That's their immediate projection in the long run. But if you look at the market expectations of where interest rates are going to go, they have them coming down to about 3.6%.
Here's the latest this morning. Fed Chair Jay Powell set to speak again on Wednesday ahead of the US payrolls report on Friday. Powell staying on message last week, saying the Fed is in no hurry to cut rates after a string of hotter than expected inflation prints to start the year. Joining us now is the former Fed Vice Chair, Randy Qualls. Randy, great to catch up with you, sir. Fantastic to get your thoughts on a major issue. A conversation we've been having now over the last week or so is whether this Federal Reserve is beginning to drift towards accepting a higher inflation rate. Is that your sense of things, or would you push back, sir?
No, I don't think that's either likely or consistent with the Fed's communication. Just before this inflationary surge started, the Fed went through a comprehensive review of its monetary policy framework, meetings all over the country. It took the course of a year. And as part of that process, the Fed reaffirmed the 2% inflation target as part of the framework. It would be quite...
I believe we might have lost that connection to Randy Qualls just then. And Pete, you had thoughts. I know you did. This is a big debate right now. It seems to be very split. And what you heard there in the early indications coming from Randy is that he did not agree. This was still about 2%. So why are you somewhere closer to 3 when they're sticking with 2?
One, they seem to change their attitude. If you go back right before we hit COVID, we had inflation under 2%, and we finally were getting above 2%. But at the time, they were saying, well, we are looking at multi-year averages, so it's fine to run hot for a period of time. So I think they change their case sometimes to allow them to be easing, right? So that point we were going above, they said no. We went to transitory. Everything was transitory, 4% transitory, 5% then we reacted. So again, they seem to create messaging that allows them to position for the easy side. Yeah. And right now, that feels the messaging we're getting, that, yeah, we're at 2.5%, but we think we might get to 2% so we can start cutting. And even if we don't, we're still going to cut for a little bit.
This is purely observational from my standpoint. It's not a judgment about what I think the Federal Reserve is going to do or not. I think the people who believe that it's closer to 3 now, I think observed Chairman Powell and what he said in August of 22, which is basically saying, you're going to have pain, we'll get inflation back down to 2. And now they sense an unwillingness to generate economic pain to achieve inflation at 2%, and they're willing to just stretch the timeline. Putting the emphasis on time to get to 2% is very different to putting the emphasis on pain to get to 2%. Isn't that a bit of a turn, a bit of a shift?
It is a little bit of a shift, though I would say, in their defense, people were saying they were behind the curve, and people were saying maybe they should stop hiking earlier because of this lag effect. So you have some of this lag effect. And the other thing is, let's not forget, their favorite metric, PC, it's rarely above 2% historically. For much of the last 2 decades, it barely gets above 2%. So they picked a pretty easy metric that it's kind of in their favor. It should head down that way.
I'm pleased to say we've reestablished the connection with the former Fed Vice Chair, Randy Qualls. Randy, thank you, sir. You were mid-thought and you got cut off. So if we can pick up where we left off, why you believe they're still committed to 2%.
Yeah, sorry about that. Just before this inflationary surge began, there was a comprehensive review of the monetary policy framework, and as part of that, the Fed reaffirmed the 2% inflation target. It would be very surprising, and it would not be good for the Fed's future credibility for them in the first inflationary surge after reasserting that monetary policy framework and that inflation target to say, well, 3% is close enough for government work, and so we're done. That would mean that the next time there was an inflationary surge with a new 3% target and inflation goes up to 9% and the Fed says we're headed back down to 3, the folks would say, well, last time you said you're headed back down to 2, why should we believe you now? So it's important for the Fed, and the Fed has been quite consistent in communicating that 2% is the inflation target. I don't think that inflation has to come all the way down to 2% before the Fed starts easing, but it has to be their preferred inflationary target measure, which is core PCE, has to have come down much closer to 2% and have stayed there for a while, and the other factors in the economy that could be inflationary, particularly tightness in the labor market, have to have adjusted themselves enough for the Fed to feel comfortable cutting.
I guess one question I have is, in the markets, he took the time back in the fall to mention the market had done a lot of his work for him. You know, treasury yields were at 5%, equities were weak, credit spreads were a little bit wobbly. Now, all of a sudden, you have yields back to, 4.25% roughly. You have equity markets doing very well. Credit spreads are very tight. And he chooses not to mention financial conditions. Is that a signal or just how he's thinking about it? That, I think, is confusing me and seems to be pointing to a person who really wants to be dovish.
So I think you've got, we're at an inflection point in the Fed's policy path and in Fed's communications. At the outset of this process, there were two hypotheses: that interest rates wouldn't have to go as high as they traditionally have in the past in order to contain this inflation, a variety of reasons for that, and that interest rates wouldn't have to stay as high for as long in order to contain this inflation, a variety of reasons for that. I think the first of those hypotheses has been borne out. Interest rates, the Taylor rule, for example, a guideline that central banks around the world have used to guide interest rate policy, would have suggested at the outset of this you needed short-term interest rates of 9 or 10%. We didn't get there. Inflation has significantly subsided. But the second hypothesis was wrong. It's going to take a longer period of time than many of us, myself included, believed at the outset of this for policy to do its work. Now, at the outset of the process, it was clear that interest rates had to go higher, not clear how high. Interest rates had to stay high for a while, not clear how long, and so everybody was agreed we at least have to do something. We're now at the inflection point where there will be differences of view among the committee and therefore different communications from the various members of the committee, and the job of the chair is to try to maintain a consensus and direct that committee to an outcome, which complicates his communication task as well. So it's going to be confusing, and people will, I think, take wrong signals by hearing what they want to hear as the tone of the messages from the various Fed communicators begins to...
Randy, this was great. One thing we have to do is we've got to do this again, because we've got to go. My apologies about the technical connection, sir. Randy Qualls there, the former Fed Vice Chair. Peter Cheer, thank you, sir. Love this over the last hour. Appreciate it. Coming up on the programme tomorrow, Troy Gajewski of FS Investments, Kathy Jones of Charles Schwab, David Leibovitz of JP Morgan, and Lorena Urici of T. Rowe Price and Bramo back in the chair, I'm pleased to say, after a long weekend. From New York City this morning, good morning. This was Bloomberg Surveillance.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
One of my greatest advantages, I own my company 100%. No board of directors. I make a decision, we move. And I had a guy say to me, runs a big media company. This guy ran a major division, Warner Discovery. Okay. It was just Warner Media at that time. He says, you know what, when we sit in our meetings, we don't talk about Disney. We don't talk about Paramount. We don't talk about Sony. He goes, you know who we talk about? I go, who? You. I said, really? He goes, yeah, you. I go, why? He goes, we are giant battleships, and you're like a little speedboat. And if there's gold on the beach, you run rings around us, get to the beach, take the gold, and by the time we turn our battleship around, you've already taken the gold. I go, that's right. I'm always gonna be that entrepreneur. I started my company from my dining room table 30 years ago. 30 years ago. And I started by calling every television station, asking them to carry my once-a-week show. On average, they all said no 50 times, and I worked through about 50,000 no's to get 150 yeses. That guy that was at that dining room table trying to pay his phone bill is that same guy today, 30 years later. That fire is still in my belly. I still run scared, and I'm still running after that vision of building the world's biggest media company.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny, in for Jonathan Farrow. HSBC are unanimously bullish on these markets and cross assets. Goldman Sachs, they say valuations are not exceptionally stretched. They're off the worry list. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
The show, futures move higher after 5 consecutive monthly gains. Upbeat China data reinforces the economic recovery hopes, and gold hits a record high as investors continue to bank on rate cuts. We begin with a big issue, kicking off the second quarter.
I think we can go quite an awful lot still from here. What we're seeing currently is that people are basically sort of neutral everything. They're ever so slightly overweight in equities, but really neutral in credit, neutral in investment grade and high yield. Everyone is sort of really waiting and desperately waiting for that dip. So to us, you know, other than a couple of percent perhaps lower in equities and a handful of basis points up in credit, I don't think there's going to be more substantial of a drop than that.
Joining me now to put Q2 on its footing, it is PGIM's Michael Collins, Catherine Avery of Catherine Avery Investment Management. Catherine, good morning to you. We start the second quarter with this unanimous bullish call from HSBC. Do you think we're going to see some kind of capitulation move from perhaps left out of these record highs to real deployment as we kick into Q2? Good morning.
Good morning to you, Manus. Thank you for having me. You know, ever since we got the fourth quarter earnings numbers and we got some rekindled optimism from management, it's pretty much been off to the races, so to speak. But more importantly, we've gotten a broadening out in the market, which we think is going to continue. So a lot of those sectors that do have better valuations than the overall market, like the energy sector, financials, those sectors we think will still continue as we go forward because they're still continuing to trade at a discount to the overall market. And it looks like we have some renewed interest finally in those areas.
Yep, certainly waking up in the second quarter. Good morning to you, Mike. I just wonder to what extent you see this level of neutrality of exposure to IG, high yield and duration that HSBC talk about this morning. We're talking the talk, but we're not walking the walk. Are they in your world?
Yeah, Manus, good morning. You know, I think investors in fixed income have become increasingly bullish on the asset class in general. And I think a lot of that is just the overall rate structure, right? I mean, the risk-free rate is really the attractive point. The credit spread, similar to equity valuations, have done nothing but get tighter and tighter. It's hard to say always if they're overvalued or fairly valued, but I don't have a sense credit investors are chasing, you know, high yield, chasing emerging market debt. I think it's just kind of long-term investors, man, is whether they're pension plans, you know, with all the insurance companies, with all the annuity sales we're seeing, are just trying to lock in this high level of overall yield. And I think they're just less sensitive to the level of the credit spread, right? The technicals in the market are really strong, meaning there's so much supply of government debt, public sector debt, and actually the net supply of private sector debt, corporate debt, et cetera, is coming down, right? So all else being equal, that leads to credit spreads getting tighter. But my sense is investors aren't over their skis in credit at all. And you know, you're probably right that people are waiting for a pullback to get more aggressive. I know we certainly are.
Yeah, well, certainly that conversation this morning on Bloomberg Brief, which was about the mania waiting for a dip, where the dip is only going to be pennies in size and scale. Let's just set the table for the Fed speak this week. There's a lot to deal with. The latest from Chairman Powell on Friday was this.
The economy is strong. We see very strong growth. We had growth for last year over 3%. Many forecasters see growth coming down to around 2% this year. That's about roughly what the first quarter looks like. That means that we don't need to be in a hurry to cut. It means we can wait and become more confident that, in fact, inflation is coming down to 2% on a sustainable basis.
Mike McKee is with me. What does not in a hurry mean? Mike, good morning.
That's what everybody has to decide. Basically, the market's taking it as the Fed is going to leave rates a little bit higher for a little bit longer. The yield curve steepening today. This is what happened on Friday. We got the PCE inflation numbers, and as you can see, the white and blue lines there, they basically show that inflation is still coming down, but at a slower pace. The slope has sort of eased, while the yellow line, unemployment, we get the unemployment numbers on Friday, has been going up a little bit, which suggests that the economy is slowing down. The Fed is looking at an economy, though, that is still producing 200,000 or more jobs a month. And so at this point, Jay Powell is saying we're not going to have to do anything. We get a lot of numbers today. As I mentioned, Jobs Friday is going to be the big day, but we do get the ISM manufacturing numbers today, JOLTS on Tuesday, services from ISM on Wednesday, and of course, jobless claims. And we have a whole bunch of Fed speakers this week, Bowman, Mester, Daly. Jay Powell back again on Wednesday. Kugler and Barr and Goolsbee all speaking as well. So we've got a lot of people to parse over the next couple of days. And we'll see if they join Jay Powell in saying the same message Chris Waller said last week, that we have some time ahead. What it means this morning is that there is a slightly greater chance of a July move. You can see the Powell gap there than there was last week when people were starting to move up the idea of June. Right now, it looks like the Fed may push it back till July, but expect, Manus, a lot of volatility. Even as this week goes on, as we get new data, people will recalibrate when they think the Fed is going to start cutting.
Yeah, we are continually recalibrating when they will pull that trigger. Mike, thank you very much, Mike McKee. My guests this morning are Michael Collins, Catherine Avery. Michael, the market has now moved to July for the first full lock of a cut. You look at the one year forwards, and you see a rate cutting cycle of 100 basis points, which is materially lower than traditionally we have seen.
Yeah, you know, I think the hurdle, man, is for the Fed to cut rates, at least over the next months or even quarters, is very high, right? As Mike just said, the economy is solid, if not strong. The labor market is probably outright strong. Inflation is still stubbornly above the Fed's target. The stock market keeps hitting all-time highs. Credit spreads are bouncing toward all-time lows. Financial conditions are actually the easiest they've been since just after the Fed started hiking. So if you're the Federal Reserve, why would you ever cut rates, given those conditions I just cited, right? So the MO for them, the general tendency is to sit on their hands and do nothing until they really have to, until the markets really get pushed. So yeah, there are, only about 2.5 cuts now priced in this year. So the markets are definitely moving in the direction of our view, definitely moving, I think, in the direction of the data, which is just let the Fed, let the markets play out, and the Fed doesn't have to do anything. But there are, these 100, even maybe 150 basis points of cuts priced in over the next, 18 or so months or 24 months. And that's really the hard part to gauge. And we're probably more inclined to take the under on those near-term cuts that actually get enacted.
And then, Catherine, I mean, this is the point. We're either desperate for a dip and we buy any dip that we see, but the cyclicality, the growth story, you can't deny it. We're probably going to get 200,000. Well, I don't know what we're going to get on Friday, actually. The consensus estimate is for 200,000 or thereabouts. I've got to catch myself. About 200,000 jobs created. But that cyclicality, I know you like financials and I know you like oil, but what else in cyclicality? How do you play that strength story?
We still like industrials as well. Like names like Caterpillar it was a great, name for us in the first quarter. We think it's going to continue. That's a name that still, even though it's had such a run up in the first quarter, valuation wise, it still looks attractive. So I think you kind of have to follow the money. Where is the money going from? From GDP, or even from fiscal spending, is going into infrastructure and it's going into tech. So the beneficiaries of that are going to be a lot of the cyclical type tech names. It's going to be the industrial for the onshoring that we're going to be seeing here in the U.S. and then energy as well. And now that we've had China look like it's coming back into focus again, energy again. These companies are still very inexpensive relative to the rest of the market. So you can still see a long trail ahead of them to have good performance.
It's amazing how the narrative for the market shifts from we don't need to talk about China, and we will do in just a moment in more detail, to suddenly, oh, China's back. Michael, I'm curious to know if you say that actually, Manus, you get this return in high yield and in investment grade and it's not stretched. Can I challenge you then, why are you lightening up? You say here that whilst tighter levels of spreads may well persist, we continue to reduce our overall credit in our portfolios. Is that just because you've had such a splendid run, or what is the motivation?
Yeah, I mean, it's a valuation story, man. It's clearly, I mean, we have seen over the decades doing this, right? Yeah, credit spreads, they hit the lows, and sometimes they bounce around these really narrow levels for years. Right? But the prospect of further spread tightening, meaning kind of capital gains on that credit risk, is really, really limited at this point going forward. So just from a pure risk management standpoint, when you're looking at, upside, downside, the upside is, yeah, hopefully you clip that coupon for another few quarters or heck, maybe another few years. But wow, we know the downside, right? Spreads grind tighter and then they blow out when bad things happen. I mean, the good thing this cycle is if they do blow out, I mean, maybe we're just one of many waiting on the sidelines to add risk, but you do have that Fed backstop, right? I mean, I think they're going to be slow to cut initially, but when things go south, man, they have 300 basis points they could do almost instantaneously to support the economy, right? So that backstop is really in place for the first time in a lot of people's young careers in this business. So I think that's a reason to kind of be constructive on credit generally, but pay attention to the level of valuations, and they're in the lowest kind of percentiles historically. So you're just supposed to play defense and sit on the sidelines a little bit and wait.
Michael, you bear the scars of somebody that's lived through a few brutal cycles in your time. Stay with me. We've got more to do. That is Michael Collins, Catherine Avery, my guest this morning on Markets. Let's go into the hood ahead of the opening bell. Simone Foxman is with me on the movers. Simone.
Yeah, Manus, one of the big positive drivers this morning, 3M, which appears to have resolved some of the issues, legal woes related to suits over PFAS forever chemicals in drinking water. The company offering $10 to $12.5 billion to settle claims by roughly 12,000 public water systems across the U.S. The federal court approved it. This is something that could have stretched on for years, now appears to be at least in part resolved. Meanwhile, UPS shares trading higher as well. The company says it will become the U.S. Postal Service's primary air cargo provider. This had been a contract that FedEx had for more than 2 decades, but now will go to UPS once that existing contract expires September 29th. FedEx, of course, taking a beating on this news. And finally, AT&T grappling with a data leak. Personal data from about 7.6 million current account holders and 65.4 million former customers appears to have been leaked to the dark web. It was leaked about 2 weeks ago, and the company is resetting millions of customer passwords. Manus.
Okay, that is a bit of a breach. Simone, thank you very much. Coming up, signs of momentum emerging in China.
Now people are just starting to think about China. You're talking about second biggest economy in the world, looking like it's starting to pick up.
We'll dig into that strong data in just a moment on Bloomberg.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rain World Cup. This is a 3.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Now people are just starting to think about China. Okay, PMI is better than expected. JP Morgan last week raised their Q1 GDP estimate to 6.6%. Okay, so you're talking about second biggest economy in the world, looking like it's starting to pick up, and that is obviously bullish for lots of things.
Suddenly upbeat China data fuels the economic recovery hopes. Manufacturing activity rebounds after 5 straight monthly declines. That boosts optimism the country could hit its ambitious growth target of 5% for 2024. Enda Curran is with me to discuss the conundrum. They've tinkered with policy, but not in the traditional ways that they did post-GFC. And so my question to you is, the policy response mechanism you've seen so far from China, it is bearing fruit?
Well, certainly on the industrial side of things, Manus, it does look like there's traction there. As you just mentioned, both the official and the Caixin PMI indicator, both now in positive territory. That suggests that the broader export upswing is helping inflate the industrial side of things. Within the PMI readings, there was a better reading for new export orders as well. So it looks like the industrial side is gaining traction. Those results came in better than expected, and it does add weight to the idea that China's gotten off to a better start on the export and trade side of things as well. Now, of course, the consumer story remains sluggish. They have yet to really rev up the real estate side of things, but at least when it comes to putting a focus on manufacturing and industrial production, that does seem to be, so far at least, a bright spot in China's recovery.
What is their tolerance for a lower yuan? What role will the currency play in hitting this 5% target?
Well, there's no doubt the cheaper currency at the margins, I would say, helps exporters. Certainly plenty of economists have questioned how much dividend it really does offer, but at the margins it helps them. But for China, it's always about the pace of decline, it's the volatility in the yuan, and that's what concerns them the most, and that's what they'll be watching closely. But as you say, Manus, there is a very aggressive growth target for this year, that 5% figure. That's a political target, don't forget, which suggests that the government and the authorities will have to meet it. And that's why a lot of economists are saying more spending is coming down the tracks. We are seeing banks upgrading their forecasts, like Citigroup last week as well, upgrading their forecast for China. So, of course, there is weakness, as I say, in consumer and real estate. But people are broadly saying this year should still be a stronger year for China's economy than last year.
Okay, and thank you very much, Enda Curran, on the very latest Caixin and PMI from China. Michael Collins, Catherine Avery are my guests this morning. Oftentimes we talk about putting in a floor, and as Enda just said, the political aspiration of a 5% growth target. But when I look at China and you look at the outflows, the capital outflows, along with the equity market disinvestment narrative, Catherine, to you, when you see this kind of base forming in growth, what does it do for the China playing into the global narrative and back here to the US?
Well, the Chinese are looking for some way to stimulate their economy, and I think that they're finally going to get it. And I think that's going to have a great impact on the economies around the world. Again, we're going to start to see an uptick in commodity prices probably from this. We've had oil already increase 15% so far this year. It could possibly even go higher. The question is, what does that do to our inflation numbers here, and how does the Fed react to that? And how, if the Fed, or not react to it on the other hand, and then what do markets do in return with that? But I think all in all, I think it's going to have a positive impact on what we see here, not just on the economy side, but also for corporate profits.
Okay, I mean, that's on the equity side. Michael, to you on the fixed income side, we're going to see this potentially syncopated rate cutting narrative around the world. It may well be Bank of England, ECB, and Fed, perhaps the trifecta going a little bit more syncopation. But when you look at the Chinese story, we haven't seen the massive rate cuts that we traditionally had associated with stimulus economy. How do you look at this floor creation, let's say, in the economic cycle for China?
Yeah, they've been going against the tide from a monetary policy perspective, really, for the last couple of years. Almost all the major central banks in the developed country, and even a lot of emerging market countries, Manus, have been raising rates, and China has generally been cutting rates. I mean, their 10-year yield is a full 200 basis points lower than ours. In fact, we've recently cut positions in Chinese debt because of the low level of interest rates over there. So, they've been trying to stimulate. To some extent, though, it's been pushing on a string a little bit. I mean, the fundamental backdrop in the economy with the real estate overhang, a weak employment picture, deflation, right? I mean, there's good GDP and there's bad GDP. Yeah, the numbers are picking up, but they're making more things and selling them at lower prices to the rest of the world. Even their input prices are coming down. The people are actually increasingly trying to get their money out. I think they've lost confidence to some extent. They've lost money in the stock market. They've lost money in all the real estate investments. And our hearts go out, to the Chinese people. It's a really tough environment. So I think you have to be a little wary of some of these headline figures and look through that. The good news is if it's painting a more global disinflationary backdrop, that does allow the Fed to, to ultimately cut rates.
So if you trim back, Michael, on your China exposure in fixed income, you see the Bank of Japan gearing up and into action. I'm just curious if you scale back or trim back in China, where have you redeployed on a global basis to?
Yeah, we're basically, flat or even a little bit short interest rate risk in general, man. It's like even in the U.S., like I said, I think the rate cuts that are priced in the next year or so might be a little too optimistic. So just, I think, similar to the credit markets, I know it sounds like, sitting on the fence, but really waiting for better entry points in the rate structure before we get long duration. So it's been, one of these worlds where you take profits when things rally a lot, whether it's different rate structures like Chinese rates or credit spreads, and you just earn your carry and you play a little defense until you get a better opportunity. And the same is true in the global rate structure.
Catherine, what would be your line of defense if I said to you, I know that you got some cracking tech names in there, IBM has done well, etc. But if there was a defensive line, briefly, what would it be for you?
I'd probably say consumer staples and utilities.
Lovely and succinct. That's what we like. You can come back to count down to the open. Michael Collins, Catherine Avery setting the agenda this Monday morning. Coming up, your morning calls, and a little bit later, Citigroup's Stuart Kaiser joins me with his outlook for stocks after logging their best first quarter since 2019. The conversation right ahead on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
We start the second quarter with a nice bid. Inflation's well behaved. Catherine Avery just with us there now, telling us to ride that cyclicality. And in terms of what Wall Street analysts are saying, this is what we've got for you. Time for your morning calls on this street. First up, Morgan Stanley naming Delta as its top pick in the airline space, pointing to a strengthening in demand at a compelling valuation. Next up, Bank of America raises Micron's price target to $120, expecting the shares to benefit from surging AI demand. And Wells Fargo adds Tesla to their tactical ideas list and keeps an underweight rating on the shares. The firm sees moderating growth, slower demand, and diminishing returns for the EV. Coming up in the show, Citigroup's Stuart Kaiser joins me around the rally. The best first quarter since 2019. Does that endure, or do you want moments of moderation in your portfolio? That's next on Bloomberg.
I was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios. And, you know, any given day it would be the head of a studio and, you know, just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
You had a pretty bullish first quarter, the best since 2019 across these markets. We start bid up. Citi have, parts of Citi have a new underweight on technology. We'll catch up with Stuart Kaiser in just a moment. RBC ringing the bell. Halima Croft there, part of the commodities team. We're bid up in these markets. As for the rest of your assets, we've got a unanimously bullish call from HSBC this morning on Bloomberg Brief, but this is how the rest of your assets stand. Records in gold. JP Morgan says it is their #1 pick in the commodities. 2,500 for 2024. China has been a buyer of gold. 10 years, yields rising ever so slightly there. We're up 5 basis. It is beginning to tick higher. So this boon that we had from, let's say, the well-behaved PCE seems to be just waning. And crude oil up 0.2%. So you have oil marching higher in day one of the second quarter, up 14% in the first. One stock to watch, it is AT&T at the open, the wireless carrier, saying 73 million accounts leaked onto the dark web. This is quite a big breach. Simone, can you put some context around this for me?
Yeah, let me give you the timeline of events here as well. The company announcing this data leak on Saturday. TechCrunch, the publication, though, saying it alerted the telecom company to the leak back on Monday and then held off on publication of its story until the company was able to engage in a mass password reset. We understand that the leak includes information including social security numbers, home addresses, phone numbers, dates of birth. The company is saying that this data appears to be from 2019 or earlier, but it did appear, this leak, on the web about 2 weeks ago. So far, AT&T is saying it launched a robust investigation supported by internal and external cybersecurity experts. It says there is no evidence that there was unauthorized access to its data, and it's saying that it will provide credit monitoring at the company's expense where appropriate. But bad news for AT&T, which was already grappling with a federal investigation into a widespread outage that had happened in February. We're watching shares off over 2% in early trading, Manus.
Okay, Simone, thank you very much. Turn our attention to the banks. We've had some guests who want to be long of these banks into this market. Analysts expect big gains from Citigroup this quarter. Wells Fargo adds shares to their second quarter tactical ideas list. Goldman adding the stock to their conviction buy list. Katie Greifeld is here. Katie, big calls.
Big calls, yeah. Citi getting a lot of love from the sell side today. Let's start with Goldman adding the bank to its conviction list for April. And then you have Wells Fargo adding Citi to its second quarter tactical ideas list. So the analyst's logic there is that Citi is embarking on a multi-year inflection, which should see better efficiency and returns. They have an overweight rating, of course, and a 12-month price target of about $80. You can see shares currently trading around 63.5 right now. So Wells Fargo and Goldman Sachs, they are two voices singing in the bullish chorus for Citigroup. If you actually take a look at the total sell side, Citi has 0 sell recommendations among the 26 analysts tracked by Bloomberg who follow the stock. And for good reason. You take a look at the performance lately. Shares are up 24% so far in 2024. That compares to just about 10% for the S&P 500. So some massive outperformance there, of course, amid Jane Fraser's turnaround efforts.
Okay, Katie, thank you very much. Let's focus in on the EV story now. Nikola is extending its rally into a 9th session. This is the longest streak on record. Tesla shares, however, under pressure ahead of a looming delivery numbers. Ed is with us. He's in New York for the week. Ed, good to see you this morning. So we're counting down to the numbers, the delivery numbers from Tesla. But talk me through the Nikola.
Yeah, I mean, Nikola is a company we talk about less. I'm micro-focused on it, obviously, given my history of reporting on that company. 9 straight days of gains is the most on record, but I won't say it's a catalyst. The news story is that Nikola's board and management are suing the founder and CEO, Trevor Milton, who you remember was sentenced to 4 years in prison in December for securities fraud. Trevor Milton had been trying through a proxy battle to install some allies of his onto the board. And what Nikola is saying in the suit is it's not illegal to attempt a corporate hostile takeover, generally speaking, but in this case it is because they feel the candidates that Milton, who is appealing his sentencing, is putting forward aren't appropriate. So that's an interesting one. The stock actually pairing its early declines 4.8%. Tesla is interesting. It's down 0.6%. The average analyst estimate is that in the first quarter they delivered 453,964 vehicles. That would mean sequentially quarter on quarter a sales or delivery decline. But the key metric to look is against the same period a year ago where they delivered around 422,000 odd. We know the story in the quarter gone. Difficulty with high rates putting off the consumer, a broader global EV growth slowdown, and then they had supply problems, the pause at the Berlin plant, sources telling us that they cut shifts anyway in Shanghai. There's a lot of focus right now, while other EV names, particularly in China, cut prices. As of April 1st, Tesla has raised prices, but I point out they said they were going to do that. And for what it's worth, I actually leased a Model Y last week, just for the experience of doing it, but it was an incredible deal. Tesla normally does that. They really go aggressive at the end of the quarter to try and boost sales in the final days in a sprint finish.
And tell me then, did you put the order in?
I did. I picked it up last Thursday, and genuinely, you know, I was looking for a vehicle. The leasing experience is very straightforward. I don't think that I, as one individual, will make a difference this quarter in the grand scheme of things, but it's a classic case or example of how they normally do things. Heavy incentives in the final few days, and then hope that they get that boost to try and exceed expectations when the final day of the month closes.
Okay, well done, Ed. The experience is everything, Ed Ludlow, in New York for the week. Let's turn to big tech now. Microsoft is planning to sell its chat and video app called Teams separately from its Office product, just 6 months after it unbundled the two products. Now, this is according to Reuters. Alex Semenova is with me. This is a shift in strategy, Alex, isn't it?
Hey, Manus, good morning. Indeed it is. If you want Microsoft video chatting, if you want Microsoft emailing services, you're going to have to pay for these two products separately now. This move by the technology giant to unbundle the services is meant to avoid a potential fine from the European Union. This is according to a report from Reuters this morning. The EU, as well as businesses, including Slack, have argued that Microsoft has an unfair advantage by coupling these offerings. As a result, Microsoft will introduce a new version of its Microsoft 365 and Microsoft Office 365 subscription services, excluding Teams. This comes about 6 months after it uncoupled the products in Europe. Now it's doing so globally. Microsoft said in a statement that this directly addresses feedback from the EU. However, businesses, including Slack, which is, of course, owned by Salesforce, have argued that in the past, Microsoft has forced installation of Teams to customers through its market-dominant suite of products. They said that this was illegal. Shares are still moving higher this morning, up more than 1.5% today. And this comes, of course, after an incredible start to the year for Microsoft. The stock was up this year 12% through Friday's close, of course, slightly outperforming the S&P 500's 10% gain. Manus.
Alex, thank you very much. Microsoft is bid this morning. Let's just reprice the 10-year government bond yields. This is the move. As you can see, we're up 6 basis points, a slight steepening, re-steepening in the curve. Twos are up much less, up by 2 basis points. You've got good core PCE. You've got good core services, inflation being well behaved. But maybe the market just a little bit irked and repricing the first full cut to July as we were in a fully extend and pretend mode from Chairman Powell. Lots of Fed speak to get our teeth into, but 6 basis points higher at the moment on 10s. Citi Stuart Kaiser weighs in on the markets, writing this: our core positive view on U.S. equity risk remains in place. Stronger nominal growth, lower unemployment, and less concern about the recent strong inflation prints, and the committee still leaning narrowly towards 3 cuts this year. Stuart, good to see you this morning. So at your core, you're positive. My question to you is, as you embark on the second quarter, do you expect the velocity of capital to be deployed into equities aggressively or tepidly? Good morning.
Hey, good morning, Matt. It's good to see you again. Look, as I mentioned, we do remain, pretty constructive on markets. Will the rate of, change be the same in the second quarter as it was in the first quarter? Probably pretty unlikely, right? It's hard to stack up, kind of 10% equity gains back to back. But, if you look historically, equities are kind of a momentum asset. So when they get moving in the right direction, they can, likely continue in that direction unless the facts change. And for us, the key there is the labor market. As long as employment remains strong, we think equities will do well, and we like, having that risk on.
Shall we have a fist fight within Citi? You've got one of your colleagues, Scott Croner. Big call here, downgrading U.S. tech. The rally will broaden, and they've got a new underweight on tech. Are you as brave as that, or a little bit more judicious?
I'm definitely not that brave. No, look, I think the broadening call at large, we agree with, and Scott has had that view for an extended period of time as well. And frankly, you're seeing it, right? Those Mag 7 stocks were about 2/3 of market cap gains for the S&P in 2023. That number's down into the 40% range. So you are seeing a broadening out. I think our view is tech doesn't trade lower. You just start to kind of fill in around the edges, and you're starting to see earnings broaden out and price performance broaden out. So, definitely on board with the broadening theme, and we do think that's, happening. It's been a very slow trickle down, in the sense that you've seen small caps still perform quite poorly, even as kind of leadership and price contribution in the S&P, has broadened out a bit. So, definitely agree with the broadening theme. Obviously, tech is a really tricky trade here, just given how powerful it's been.
Indeed, and there is the Mag 7 today. Again, Tesla on the back foot along with Meta, but certainly Tesla has been one of the biggest underperformers. Can you, everybody's sort of clamoring for the year of the bond, aren't they, Stuart? And here we are in the first quarter. Stocks had a roar, up 10%. You point out that bonds underperformed by 2%. I'm not even going to ask you whether you think it's going to be the year of the bond, but do you think that incrementally do we move to the quarter of the bond? That's how our timescales have narrowed so much. That relationship between stocks and bonds, just lay out the narrative for me, given the gap that you saw in the first quarter.
Yeah, look, I think the first quarter was just emblematic of the fact that folks were expecting a large number of rate cuts, 7 cuts, and 4 of those have gotten priced out. I think we would argue that probably 2.5 or 3 of those 4 cuts that got priced out were for growth reasons, and that's why equities have done so well. You've priced out some cuts. It's been because growth is very strong, and that allowed equities to significantly outperform bonds. I think now that you're down to, let's say, pricing about 3 cuts for the year, that does set up for a much better risk-reward perspective for bonds. So I think there's the potential for bonds, I think, to perform better in the second quarter. But, the fact is, again, to my momentum comment before, when equities are on the front foot, they tend to stay on the front foot. So we still prefer to be in the equity market, but I would argue that positioning and certainly the pricing of the rates market is much cleaner now than it was to start the year. So, risk reward does look a little bit better on that side of the ledger as well.
Yeah, and we're getting more clarity, aren't we, with each piece of information. Although the market has moved out to July for its first full rate cut. We're going to get the jobs report on Friday, Stuart. Is 200,000 a solid, robust number for you? Because you make it very clear, where the jobs market goes, so goes your proclivity to shave risk and add.
Yeah, 100%. I think, consensus is about 200K plus or minus 25K, I think, one standard deviation. So, yeah, I think that's a very, very solid number. If you look at the consensus, it's 200K. It's about, less than 30 basis points of wage inflation, and they've got the unemployment rate easing a little bit. Andrew Hohenhorst on our econ side is a little more conservative about it. I think he's at 150K. But either way, I mean, those types of numbers, if you're printing between, 150 and 200K jobs, that's solid underlying growth. I think that continues to push out any recession risks you might have had. And in our view, that is very, very supportive for equity performance, particularly with the Fed seemingly comfortable with where inflation is at this point. So if you had asked me a month ago, I would have said, we're very worried about the wage inflation we're seeing. But last month, the wage inflation came in, and the Fed seems to be, nothing to see here type mode. So, yeah, I think that the job data, that consensus forecast, is quite positive for equities in our view.
Do you think we had Randy Quarles just over 43 minutes ago, just at the end of surveillance, talking about how heinous it would be if the Fed relented on its target in any way of getting to 2%? We're at 2.8, 2.9% on these inflation numbers. How much closer to 2% do they need to get to actually pull the trigger on rate cuts? Because to me, that looks as if it's later and later than any of us presume.
Yeah, I agree, but, their commentary has been if inflation looks like the last 6 months of 2023, then they're comfortable cutting in that environment, and what I would call those would be insurance cuts. So I think if we get the type of inflation we've seen in the last couple of months, they're going to be pretty comfortable cutting. I'd be very surprised if they were to communicate at all any sort of comfort with changing that inflation target. I mean, this is a Fed that's very concerned about market-based inflation expectations, so I don't think they're going to communicate anything that would start to dislodge those again.
It is all about the insurance cuts, and it's about the direction of the cycle, the start of the cycle, perhaps more than the totality. Stuart, thank you very much. Stuart Kaiser with his calls on the markets. Coming up, we have tension simmering in the Middle East.
I think the idea of a red line is difficult to understand because the U.S. does support operations against Hamas, does support Israel eradicating Hamas. It's just how that's done.
A conversation next on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, But I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
The idea of a red line is difficult to understand because the U.S. does support operations against Hamas, does support Israel eradicating Hamas. It's just how that's done. So as long as Israel doesn't conduct an operation that results in massive civilian casualties, that appears to be consistent with U.S. policy.
We understand the U.S. and Israel are set to meet virtually today to discuss the alternative proposals to an invasion of Rafah. According to reporting from Axios, this coming after the Israeli Prime Minister Benjamin Netanyahu vowed to carry out an attack on the remaining Hamas fighting battalions in that location. Anne-Marie Hordern is with me now. Protests on the street in Israel yesterday evening, Anne-Marie, they were quite significant. This discussion today, what can you tell me about that?
Well, what we know is just as reporting from Axios that the two teams, the Israeli and U.S. sides, will be meeting in terms of virtually, and this will be discussing this potential offensive we will see from the Israeli side into Rafah. Axios is reporting that Jake Sullivan, the president's national security advisor, will be leading the meeting. People from the Pentagon, the State Department, other U.S. intelligence agencies will be present. It comes after, of course, Netanyahu decided not to send that delegation we were supposed to see in Washington last week, and that came after the United States did not veto that resolution to call for a ceasefire and the hostage releases in the UN. So potentially it's a little bit of taking the temperature down when it comes to this relationship. We have seen this relationship, or these two individuals, Benjamin Netanyahu and Joe Biden, growing increasingly further apart. Remember, recently, Biden had said that it would be a red line to go into Rafah. Previously, the administration was talking about the fact that if they went into Rafah, they would have to make sure that those Palestinians, innocent civilian lives, they would have to make sure that they can protect those individuals, similar to what Rule said to us earlier today. It is about how Israel goes in. And Netanyahu last night, even though the organizers in Israel said it reached 100,000 Israelis were protesting him on the streets, he spoke yesterday, and he said the U.S. has ideas about how potentially we could protect civilians and not have as high casualties if we go into Rafah. And I think that'll be the main crux of this meeting today.
Well, the message from Netanyahu is very clear. It is the right thing to do operationally and internationally. This was his response. It takes time and it will be done. The question is about moving those people in Rafah. Anne-Marie, thank you very much. Anne-Marie Hordern. Let's turn our attention to the commodity market. Prices are steady following a solid first quarter gain, driven by better than expected demand in Europe. Anthony DiPaolo is back with me again. We've got a little bit of slippage going into this session, Anthony, down in 1/8 of 1%. But we have sanctions that are biting, and we have a demand scenario in China that is perhaps a little bit more bullish than we had anticipated. Take me through the narrative as we start Q2. Good afternoon.
Hi, Manus. Good afternoon and good morning to you there. Yeah, as you said, oil is coming off a pretty good first quarter, a good start to the year. We're seeing a lot of momentum in prices because of that optimism that China is turning the corner, is going to be expanding. And we've also got those OPEC plus cuts as well, too. They've been taking oil off the market so far this year to tighten things up. There's a lot of new non-OPEC supply coming from the U.S., coming from Brazil, coming from Guyana, and that's going to take up a lot of the demand that comes into the market this year. So that is one of the challenges that OPEC is dealing with. We've also got those geopolitical issues. That's putting a bit of risk premium on prices. But we are seeing the market tighten up as we deal with those cuts, as we look at that higher demand scenario. And so the expectation is that those prices are going to be tightening up a little bit towards the end of the year as that market gets tighter because of those cuts. So we'll probably see OPEC holding steady through this first half. They've got an experts meeting coming up this week. Not expected to make any recommendation for a change, so we'll probably see steady as she goes for now on the OPEC Plus front, Manus.
Anthony, thank you very much. Anthony DePaolo there, setting the stage for Q2 in the oil markets. A little bit of breaking news on the March manufacturing numbers here in the United States of America. Simone is with me in the studio, so a bit lighter than we estimated. Simone.
Yeah, Manus, the S&P Global U.S. Manufacturing PMI coming in at 51.9 for the month of March. We got that flash number about 2 weeks ago. That was 52.5. So as you said, a negative revision to this measure of prices received by manufacturers and service providers. This is the first monthly decline since December, but it is the third straight month that we are seeing these numbers firmly in expansionary territory over that 50 level. We are expecting as well the ISM manufacturing PMI at 10 a.m. We'll see how that stacks up. Analysts are expecting an improvement there, but that number to stay below 50. When you look through some of the stocks that are moving across the board today, we're seeing most of our S&P sectors in the red, healthcare and real estate among the worst performing today, which are seeing communication services and information technology really holding up the gains here. Those were among our leading sectors in the last quarter, whereas the likes of real estate was actually, you're seeing the negative there today, the only large sector coming in negative for last quarter, Manus.
Okay, Simone, thank you very much. The latest on the data there, a little bit lighter than the flash. Coming up, market moving events for your calendar. It's a busy week of Fed Speak. Good morning from New York.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is your trading diary. We're revving up at the start of Q2. ISM manufacturing will be at the top of the hour. That's after the S&P numbers we've just had. JOLTS data and a host of Fed Speak kicks in Tuesday. Wednesday, you've got the ISM services data. The inflation there being well behaved. Initial jobless claims hit the table on Thursday. And of course, the crescendo is the US payrolls report on Friday. The estimate is for 200,000 jobs to be created. That was countdown to the open. This is Bloomberg.
general advice is continue to seek out companies or people that are maybe 1 stage or 2 stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that. We'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the fire line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
In fact, expansionary territory, anything over 50, and we're getting 50.3 for the manufacturing number for the month of March. As far as stocks, first trading day of the new quarter, first trading day since the release of the Fed's preferred inflation gauge. Stock averages are mixed right now. S&P 500, little change. 8 of the 11 major industry groups in the index are lower. Best performing stock in the S&P 500 right now, that belongs to Micron Technology, up close to 5%. Bank of America raised its price target on the stock. And meantime, for Lori Calvasina at RBC Capital Markets, Friday's inflation data did leave intact the idea rate cuts are on the way.
So look, I don't think there are any major surprises here from my end. I mean, we've generally been looking for a moderation in inflation at RBC. Our guys cautioned me very early, in the year, late last year, that there are going to be some bumps in the road. And for now, the thesis still seems to be intact, and our guys still think we're headed for June cuts.
Analysts lowering their projections for this week's deliveries report from Tesla as the quarter comes to a close. And AT&T says personal data from about 7.6 million current account holders and 65 million former customers leaked onto the dark web. Once again, S&P 500, little changed, up just about 3 points right now, 52.57 on the index. The Dow, 177 points lower. And the NASDAQ Composite Index, 75 points lower. Quick look at Treasuries. They're on the move right now. 2-year, which is more policy reactive, that's up 6 basis points. The 10-year, that is 10 basis points higher. That's up to 430 right now. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Happy Monday, Alex and Paul.
It's so nice to have you back.
I was filling in for one Charlie Pellet for the afternoons. Nice change.
And I can report that we had Charlie. He is alive. He survived his visit to the world's most dangerous airport in Nepal.
Truly, the world's most dangerous.
Did you guys see the video on Instagram?
Where it lands
No.
uphill?
Oh my gosh! Like even just the audio on those videos was crazy. But it's nice to have you back, John Tucker. We appreciate that.
Yeah, I was like kind of mixed emotions about whether or not he was going to make it because
You
the
like coming in
afternoons,
later today.
sleeping later, you know,
and then taking a ferry into work is the gentleman's way
that's
to commute.
the way to go.
That is the way to go.
Oh well, you're stuck with us now.
Yeah,
Exactly.
he survived.
But interesting on those ISMs, expansionary territory here, ISM manufacturing coming in at over 50. So let's get to the man behind the data. Tim Fiore is chair for the Institute of Supply Management's Manufacturing Business Survey Committee. Tim, we knew we were in the trough. Is this legit expansion here?
Yeah, absolutely, Alex. Good morning, Paul. Good morning, Alex. So this is the third month of recovering demand, and there's not a lot to complain about in this report. I mean, we've got good demand that beat the seasonals, expanded for it's on average the last 3 months. It's an expansionary period. We had production go up, which is output, pretty significantly. We were continuing to have layoffs, which I think is good, but that should probably end soon. Suppliers are starting to stiffen up. So overall, this is a very good report. Remember, last time we spoke, August, September, we declared that we thought we were in the manufacturing trough. Then January, we indicated that we thought we were starting to climb out. We climbed out in January, a little bit of February, and even more now in March. So we're well on our path here to a good manufacturing recovery.
And Tim, you always tell us to kind of focus on the new orders, and new orders showed some expansion as well.
Yeah, they sure did. They popped back above 50. We also had pretty significant new export orders. They were flat expansion to the prior month, but they're expanding nonetheless. Backlog was stable, which is okay. It's in the mid-40s. That's all right. That'll come back probably in the early summer. And customer inventories went way too low again, which is very good. So we've got demand increasing. We've got production increasing. We've got staffing being finalized here. We still had a 1-to-1 hire-to-fire ratio, which means that we still have a lot of companies letting people go. 70% of our layoffs, attrition, freeze activities were actually layoffs. So, people would be getting a little bit more urgent on the tool to use. And like I said, on the input side, we had inventory still contracting, but getting very close to 50. Across all the industry sectors, they all did well. None of them did exceptionally well, but most of them came in above 50 of the top 6. If they didn't come in above 50, they were like 49. So, March is a big manufacturing month. We have seasonal factors that hit us. We overcame the seasonal factors. We only had 30% of manufacturing GDP declining in the month, down from 40% the prior month. And even more importantly, only 1% of manufacturing GDP contracted below 45. Yes, Alex.
So Tim, you were mentioning the layoffs, like legit layoffs. Do we expect that to end if we wind up seeing manufacturing truly recover? Like you mentioned recovery, and I'm wondering what that looks like and then what the reflection is on the job market.
So, a couple of reasons. I think companies are cleaning up their staffing. We did a lot of urgent things over the last couple of years to get headcount, probably hired some people that we don't really want to keep. So some of that cleansing is going on, but we are going to cross that conversion line where you need the labor regardless of whether it's 100% productive or 95% productive. So I think we're going to see that layoff activity start to diminish. In fact, I'm going to start to reverse the metric and start to look for hiring activity. So I would guess that probably by June, we'll see that slow down, especially for the second half of the year.
Tim, thanks so much for joining us. As always appreciate getting your insights here for this data. Tim Fiore, chairman of the Manufacturing Business Survey, the Institute for supply management. Again, the ISM manufacturing headline number came in at 50.3, signaling expansion above 50. The consensus was for 48.3, so well above consensus. And last month was 47.8. So as Tim was saying, good momentum there for the manufacturing side. And Alex, you pointed it out earlier, we're seeing in the yield curve, the 10-year Treasury up about 10 basis points. 4.30% here, so we'll keep an eye on that. Let's take a look at these markets because we have kind of mixed out there. The S&P unchanged, the Dow off about 170 points, but NASDAQ up 76 points. Let's check in with Alex Semenova, Bloomberg News. She covers all the markets for Bloomberg News. She joins us live here in our Bloomberg Interactive Broker Studio. Alex, what are you looking at this morning?
Hey guys, great to be on with you as always. A lot going on today, but I'm going to start with one of the biggest company stories of the day. I hope that you guys don't have AT&T because
I do not.
Verizon Wireless, baby.
Good news for that because apparently personal data from 73 million accounts was leaked to the dark web. That's 73 million AT&T accounts. That's about 7.6 million current account holders and 65.4 million former customers' data. This leak happened about 2 weeks ago. It includes personal information, including people's social security numbers, and appears to be from 2019 and earlier. This is according to a statement from the company on Saturday. The stock is down about 1.5% right now. This is the worst day since February 22nd earlier this year. The source of the data is still being investigated. AT&T says that it's not clear at this point whether this came from the company or a vendor. It said that it doesn't have any evidence of unauthorized access to its systems, and that the leak so far has no material effect on its operations, but we shall see. It reset millions of customer passwords after that leak.
That's a good thing. So not good for for AT&T, but UPS doing pretty well, securing a nice government contract.
Yeah, so UPS said it was awarded a significant air cargo contract by the United States Postal Service. It will become the USPS's primary air cargo provider. This significantly expands an existing partnership between the two. Shares were up today. USPS's current air cargo contract with FedEx is set to expire in September. Apparently, they had discussions and couldn't come to an agreement. FedEx did say in a regulatory filing that it wasn't able to reach an agreement on mutually beneficial terms with USPS.
Uh-oh.
That's not good.
That's not
All right,
good for
anything
FedEx.
else for us?
Also taking a look at Microsoft, it's going to sell its chat and video app Teams separately from its Office product globally. This is an attempt to avoid a potential fine from the European Union. This was initially reported by Reuters this morning. The EU, as well as businesses, including Slack, have argued that Microsoft has an unfair advantage by coupling these offerings, so it's going to sell them separately now. It's going to introduce a new version of Microsoft 365 and Office 365 without Teams, so you have to get that as an individual product. Microsoft did say in a statement that this is directly in response to the EU, but again, Slack, which is of course owned by Salesforce, has argued in the past that Microsoft forced installation of Teams to customers throughout its market-dominant suite of products. Shares are still up today, and that is of course after an incredible run for Microsoft. The stock was up 12% year-to-date through Friday's close.
Market cap 3.2 trillion with a T. Stock up 50% over the trailing 12-month basis, so just an amazing move there. Alex Semenova, thank you so much for joining us. Alex Semenova covers all the equity markets for Bloomberg. TSLA, Tesla, as Mr. Musk likes to pronounce it. Stock's down 27% year-to-date. I mean, there's a million cross currents there, so let me just bring in someone who kind of, I think, can clear it up for us, Alex. Steve Mann, he's Global Autos Analyst for Bloomberg Intelligence. Hey, Steve. Stock's down 27%. I'm sorry, stock's down 30% year to date. What's the rub on Tesla right now? What's the big bear case for Tesla?
Hey, Paul, thanks for having me on. The big bear case is really, how are they going to do this year? EV sales in the U.S. market slowing down. China sales have slowed down as well. Even with steep price cuts in both regions. And then, they have the Cybertruck ramping up, and, it's not the most easiest product to build, so they're facing some challenges there. So earnings, I think growth is going to slow down this year. Free cash flow growth is going to slow down this year. So that's the main overhang on that stock right now.
Well, also, we're waiting for first quarter deliveries. I'm totally unclear as to when we get that number, but it does look like Wall Street analysts are getting more negative and more negative on what they'll actually be able to deliver. What are you modeling?
Yeah, so their numbers supposed to come out tomorrow, but if you look at the Chinese auto sales, like NIO, XPeng, BYD, they all have reported. They had really strong March sales number, but that's on the back of really steep price cuts over the past few weeks. So if you look at those numbers, you kind of infer that probably, Tesla's going to report, probably low single-digit growth, maybe flat to slightly up year on year in the first quarter. That's pretty much in line with consensus, because consensus estimates have come down over the past few months already.
So, Steve, what's your view of overall demand for electric vehicles? It seems a lot of folks feel like, boy, that it's kind of peaked. The early adopters, they're done. The tree huggers like Matt Miller, they're done. What's the ultimate demand for EVs, do you think?
I'm actually optimistic about EV. I think EV, that ship has sailed.
Okay.
And I think we're just seeing a cyclical downturn. Part of it is because the product that's available to the masses is still not there yet. A lot of the EVs that are on sale today are over $50,000. A lot of people cannot afford $50,000 cars, especially in a high interest rate environment. So I think a lot of the automakers, including Tesla, GM, and the rest, are introducing more affordable EVs in 2025 and 2026. I think that's going to expand the market a little bit more. And hopefully, my hope is that, sales will come back at that time.
Well, to that point, and this ties into Tesla delivery sales, because Elon Musk has talked about the fact that getting from their sexy models now to the affordable models later, there will be a sales slump as they kind of fix production and they ramp it up, et cetera. How long do you think that gap, slump, et cetera, is going to last for?
Well, Tesla's going to introduce the compact vehicle that's supposedly under $30,000. They're going to start production in the second half of next year. And we probably don't see any contribution to profitability and cash flow until 2026 and 2027. So it's not that too far. It's not that far from now. And GM is doing the same thing. They're reintroducing the cheaper version or lower cost version of the Bolt in 2025 as well. So I think it's not that far away. 2024, like I've always said, it's going to be an adjustment year for a lot of automakers. They gotta reevaluate the cost structure, reevaluate the portfolio. And, again, this is why I think it's a cyclical downturn. In 2025, 2026, you're going to have cheaper cars, lower costs, and hopefully better earnings for the EV market, EV automakers.
So, Steve, do we know whether the industry, I'm not even going to call out Tesla or GM, can the industry replicate the profitability it has on its internal combustion engine vehicles, which I understand now the unit economics are very good. Can they replicate that or in the EV space?
Yeah, it's very possible because battery, lithium prices have come down quite a bit. It's stabilizing at a lower level. The whole auto industry is reevaluating their manufacturing, how they build cars. So vertical integration has become a very important kind of strategy for automakers to cut costs across the supply chain. That will take time. And then thirdly, the IRA, the Inflation Reduction Act, is supposed to onshore a lot of the battery manufacturing. Again, that is supposed to cut costs for automakers, and that's why I think in 2025, 2026, they're able to roll out more affordable EVs at a lower price, and hopefully, if volume does get there, it's going to be a lower cost per unit.
Hey, Steve, 30 seconds. Why is GM at a 52-week high today?
Well, they've done a great job in managing the investors by buying stock spending a lot of money to buy stock at an accelerated rate, and investors love that return of cash to them.
Nice. All right. If you can't, beat him, join him. That's a good thing. Steve Mann covers all the auto stuff for Bloomberg Intelligence. We got a great global team following the global auto business. Steve just relocated from Hong Kong back to the U.S. to Princeton, New Jersey, so he knows that global auto space, including the Chinese market, which is such a key market for the global auto manufacturers, particularly Tesla, who's got a big commitment there. So keeping an eye on that. GM, it's just kind of interesting, 52-week high, up 26%. Tesla, down 30%. How the tables have turned, at least in the short term here. The fortunes there, it seems like the big U.S. automakers have been chasing Tesla stock for years. Now a little bit of a change here. S&P 500 absolutely unchanged on the day. We'll have more coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. Let's start with the economic data. The ISM manufacturing figures beating estimates well above the forecast, in fact. Input costs climbing. Could be inflationary there. We have Treasury yields. They are rising. Dollar also higher. Well, after the S&P 500 notched its fifth straight month of gains and its 22nd record close, the index this morning slightly higher In fact, it's just turned lower, down about 4 points, so we're going to call it little changed. After the Fed's preferred inflation gauge on Friday, traders now waiting for the payrolls report. And yes, more Fed speak. Fed Chair Powell, this time he's going to be back at it talking on Wednesday. The NASDAQ this morning, that's outperforming with Alphabet and NVIDIA leading gains in the mega caps. Again, the S&P 500, 4 points lower. The Dow Jones Industrial Average down 223 points. And the NASDAQ 159 points higher. That is up 0.3%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alice.
All right, thank you so much, John Tucker. So as John was just talking about, we're looking at a sell-off all across the bond market here, particularly in the long end. And it seems like the good data is going to be bad then for the market. Are we seeing actually a reacceleration of the economy? I think that's going to be my question of the day, Paul.
Oh, I like that. We'll go with it.
Let's do it. Carol Pepper is founder and CEO at Pepper International, and she joins us now. Carol, are we seeing a reacceleration?
No, I think we're seeing a steady, continuing good performance. Reacceleration would imply that it's going to get a lot hotter too quickly and it will not allow the Fed to cut. I don't believe that's the case. I think we're just going to continue to see a good, strong, muscular market that's doing well. I don't see it as a reacceleration. I see it as fairly a steady state, almost a Goldilocks market, not too hot, not too cold.
So if that with that background, Carol, what do you think our Federal Reserve is going to do in the upcoming meetings?
I'm definitely in the camp that says they're going to cut in June because they have no reason to keep the rates so high. I mean, there's not a lot of justification if we don't have rampant inflation, and the rates being so high do threaten the real estate markets, which in turn threaten the banks. So, you know, a lot of people have been holding on by their fingernails, and a lot of banks don't want to take back all that real estate, so they really need to start cutting.
Okay, so if we just do, so if things are just humming along and doing all right, as you were just saying, is that enough for equities to keep going up?
Well, remember, we're going to have the stimulus coming, a real stimulus, which is the cut of interest rates. That will help real estate. That will help banks. That will help consumers because their credit card rates will go down. And
but if we don't get that, Carol, if we don't get the cuts, or if that gets pushed off, even by a month, et cetera, can stocks still go up?
Yes, I think so, because again, we're at the beginning of another level of secular change. I was around trading the internet when it first launched, and everybody said it was too expensive. Don't buy it, and look where we are today. You know, will there be blips? Yes, but the AI revolution really is going to be another huge leg up in productivity, and that's why you see the NASDAQ running as strongly as it is, because people remember, a lot of people, you know, still around, they remember how it worked out last time. So AI is a secular change. The money that's been poured in by the Inflation Reduction Act is a secular change. These are real things that are causing real things to happen in the real world, and those are additional boosts, even if we don't get the rate cuts. So there are very positive headwinds. And certainly if you compare what's going on here to the, you know, threat of Russia looming over Europe, the threat of China looming over Asia, you know, where do you go in the world? Middle East or here, really? That's why you see a lot of people moving to, you know, UAE and people bringing their money to the United States. Lots of international clients. As you know, I work with family offices. I manage money for people with over 100 million who have single family offices, and they're all looking at the U.S. as a safe haven, and that's going to continue because on a relative basis, the U.S. looks fantastic if you think about going to other regions of the world.
So do I stick with my large cap growth stocks, Carol, that have been working for me, or do I try to go out there and find some value?
No. Forget value.
Oh,
in my opinion, I mean, you can.
That was hard.
Honestly, value has. I've been hearing about the renaissance of value for 40 years. It never comes. Okay, it just never happens. It's like waiting for Godot. I mean, the United States is a leader in technology globally, and if you stick with the large cap growth stocks, particularly ones with lots and lots of cash on their balance sheet, which you can easily see if you look on, you know, any online system. If you're a trader on Bloomberg channel, wherever, you can see how much cash do they have on their balance sheet. That means they can weather any storm. So, you know, Microsoft, Amazon, Google, these big names are going to continue powering upward.
So, okay, to that point, if I didn't own, though, say the Mag 4, Fab 4, is it too late to do that? Or do I need to just sort of play the themes that you're talking about that are real structural shifts in different ways?
No way. You have to play the big guys.
Okay.
This is a leader's market, and there are lots of fear days coming. Don't think we're done with fear days. Fear days are the days when something spooks the market. Let's say Powell says something that makes the traders fret that, oh, he really isn't going to cut. Oh my God, what's going to happen? And everything will drop like a stone. And you, smart trader, are waiting on the sidelines, and you'll get into those big names. There will be fear days. There will be fear events. That's just the way things roll these days. So on those days, you can get in if you want to get a better entry point. But frankly, you know, I remember when Amazon first came out and everybody said it was too expensive then. It's, you know, or Microsoft, these are up 200, 300,000%. I mean, there's no waiting for the exact right day isn't the answer. The answer is get into those stocks, particularly for your retirement accounts or your kids' college. Stick them somewhere. Don't look at them every day, and just know that you've made a great, solid investment for years to come.
EMXC. What is EMXC, and why should we buy it?
Okay, EMXC is the Emerging Markets Mexico Fund. So I've been spending a lot of time lately in Mexico. Mexico is the destination for a lot of the nearshoring activity, meaning people are moving their operations out of China's sphere. Not only China, but anywhere China, for example, like Hong Kong, anywhere where China has undue influence. They're moving those operations to Mexico. Mexico is on fire. If you go to Monterrey, the building is unbelievable. If you go to Tijuana, the building is incredible. Why? Because all these, both European and U.S. corporations are moving operations there. So that country is doing extremely well. Of course, they have, like a lot of countries right now, they're a little nervous about the presidential election coming up. But once we get past that, that country is going to continue to do extremely well. So that's a way, with a small percentage of your money, to play a trend that's going to only get bigger over time.
Does that also go to Canada, Carol, or is that purely a Mexico play?
No, because the wages are too high in Canada. So that's why they go to Mexico. So it's sort of, you get emerging market wages and labor in a market where you can literally, like Canada, drive into the U.S. But unfortunately, Canada doesn't have enough labor to take all of our nearshoring, and they're more like us. They have high wage structure, so that's why people go to Mexico.
Are people going to increasingly go to India if China is less investable here? A lot of folks have been suggesting that's the next trend in emerging markets.
Absolutely. I mean, for example, two important things happen in February. MSCI, the index for, you know, the rest of the world, if you will, increase the weighting for India and decrease the weighting for China. India up 2 points, China down a point. JP Morgan this coming month is going to be adding India bonds for the first time into their international bond index. So India is muscling in, and China is falling behind because they're just not playing ball with the rest of the world. So yes, India is a great trend. Right now, it's easier to buy India through some emerging market ETFs that are equity focused. There's really not a lot of great debt options yet, but I think those will come, because what tends to happen? The street gets excited when a country is included in indexes. Now it's worthwhile to go and build products around that country. So that's why there's INDA, which is a great ETF that you can look at, and there's GLIN. Both of these, you know, GLIN was up 53% last year. It's smaller, but INDA is $9 billion already, and it was up over 30% last year. So
Carol, before we let you go, though, I just want to get one take. Like, what's the biggest question? Like, we covered a lot of ground. What's the biggest question you're getting right now from your clients?
Well, it's really, will this good time last, frankly? And I say yes. I say this year, it's an election year. The good time will last. Don't be too frightened and jump out because you're scared, and don't try to time the market. Look for long-term trends that will work for you in the right proportion for your portfolio, and stick with them. Don't go crazy. Unless you have a day trading account, that's a whole other story. But if you're investing, find the right trends and ride them over the long term.
Carol, thanks a lot. We really appreciate it. Carol Pepper, founder and CEO over at Pepper International. So interesting, because it just flies in the face of like my philosophy, which is gold in soup cans kind of under the bed. But speaking of gold at a record high, but that, you know, like, don't get scared. We'll have down days and sort of buy the dip in the large guys. I always wonder what the first mover advantage is for the AI trade. Like, do you want to buy the first guys, or do you want to buy the fourth derivative, fourth guys?
I don't know. I mean, a lot of Apple investors are suggesting, you know, Apple arguably has missed the early move, but they often miss the early move. They wait for people. And so don't worry about it. Apple will be there. There'll be an AI play there maybe as soon as their June developer meeting, but the chip makers have been the ones that are just the clear winners. Obviously,
Right.
NVIDIA, but just the chip sector broadly defined has been, I guess, the initial winners for the AI. And then the question is, do you broaden that out to software like a Microsoft and so on and so forth?
And then also, I liked your question about value, because I feel like the theme of the second quarter is rotation, broadening out of the rally, and then she's like, no, not going to happen.
Yeah.
Like, just go by the big guys, which is quite interesting.
Yeah, it's, I mean, very aggressive call. I would say it's even a little out of consensus call, sticking with it, and kind of, you know, literally in her notes, she's saying, go out and buy NVIDIA today, basically, in her notes. So we'll have to see. So Carol Pepper with some bold call, staying aggressive, if you will. Dow Jones Industrials off 0.5%, 225 points, 39,500. With our news in New York City, here's Michael Barr.
Thank you very much, Paul. Alex, John, President Biden will visit Baltimore this week to get an update from officials on recovery efforts following the collapse of the Francis Scott Key Bridge. Meanwhile, a fourth Navy crane is set to arrive to help clear the massive wreckage, and warnings from a Maryland lawmaker on how the bridge collapse that forced the port closure could hit the supply chain hard, and possible increases in prices for everyday goods. Democratic Congressman Glenn Ivey hopes a quick repair may temper price hikes.
This isn't something to play games with. This isn't a gotcha scenario. We need to just come together as a Congress, as, you know, leaders in the United States, put the funding together to get this done, because there's definitely a national benefit to getting it back up and running.
East Coast ports are modifying their operations to absorb cargo diverted from Baltimore Harbor. Authorities are establishing a temporary channel to reopen traffic. Turkey's main opposition party retained its control over key cities and made huge gains elsewhere in yesterday's local elections. It is a major upset to President Recep Tayyip Erdogan, who had set his sights on retaking control of those urban areas. We get more from Bloomberg's Roz Matheson.
It doesn't impact Erdogan and his hold on power directly. He was re-elected, of course, not that long ago himself, and he won't face re-election again for a number of years. But it really is a message to him and his party about things like the handling of the economy, for example, and signs of real discontent growing in what were, you know, for many, many years, his strongholds.
Bloomberg's Roz Matheson. The UK's royal family making a big showing for the country's Easter holiday yesterday, with King Charles making his first significant public appearance since his cancer diagnosis. Notably absent Princess Kate after her announcement about her cancer diagnosis. Global News, 24 hours a day and whenever you want it.
Today, I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Your Bloomberg Business Flash, Paul and Alex.
Thank you so much, John Tucker. So nice to see you. I also know why you like coming here, because you don't put on makeup.
That's true.
That is
I
the
was
upside for you.
forced last week to put on makeup. Not that the people in the makeup room are
Fantastic.
wonderful people, but it's just, I don't know.
Men complain like babies when they had to put on makeup for TV and radio.
Why
I'm
don't you
just putting that out there.
Take me as I am.
Because
with all my blemishes.
that's not how the world works, John Tucker.
You have to invest in your face,
You have to
John.
invest. Thank you, Paul.
Yes.
I am learning. Invest in your face. There we go. All right. That was my daughter chiming in there. We're on air, by the way. Okay. I'm Alex Taylor with Paul Sweeney. You're listening to Bloomberg Intelligence Radio. We cover all the top news with our analysts worldwide. We are live from the Interactive Brokers Studio here in Midtown Manhattan. You can also catch us on YouTube. Succession is tricky, as we see from the HBO series. Some companies do it well, some do not do it well. Some are question marks, and Bridgewater might still be a question mark. Nir Bardea has attempted to revamp the hedge fund over the past 18 months and has had mixed results. So can Bridgewater really move beyond Ray Dalio? Well, Catherine Burton wrote the definitive piece today in our big take here on Bloomberg. Again, is there a result, Catherine? Yes, no? Can he do it? Can he not?
It's in the question mark category.
So still, yeah. So why is it hard? Like, what's the legacy of Ray Dalio that makes it difficult?
I think the biggest problem for them is in the models they use to manage money. I think they've moved beyond, some of the cultural things that Ray put forth that made things not work that smoothly there. But I think for the now it's just if the models are can be adapted to the market.
So what
enough.
is historically been their strategy, their model?
Their model has been come up with timeless rules about finance. You know, when bonds go up, then oil does X, or stocks go down, or whatever. They figured out these rules, and then they put them in a computer model, and then that runs the portfolio. But the inputs, in the past, I'm told it was hard to get new data into the models.
So what are they trying to do now?
They are allowing more people. Before, it was a very closed circle. There were only a few people who could see the entire model. Now they're opening up to more people internally so that people can say, oh, you did this, but did you think about doing that? Or also, they've been hiring a few people from outside who didn't grow up at Bridgewater and said maybe they have some ideas about some of these timeless rules that we can put into our model.
So how has their performance been over the last several years?
It's been very mixed.
Okay.
Last year, they had a very poor year. It was one of their worst in their history. And this year, they are up more than 15% through close to the end of March. And so that's very much better than a lot of their peers.
So how involved is Ray Dalio in the company still?
He just sits on the board, that's it.
But is that, like, what are the tentacles from there?
I think that he's really a lot less involved. I think there's enough people around him. He's not involved in investing anymore except as a mentor. Mm-hmm. And they really have changed the way they do things enough that is proof that he's not really as involved in that. Mm-hmm. And also they've gotten rid of, he had all these cultural things, like you would go around with an iPad and rate each other on if you had done a good job or a bad job, and that's all gone. Mm-hmm. And again, he let that disappeared, so he doesn't have that much power in that.
So at the end of the day, it's all about performance. What are the assets under management now, and how's that relative to history? And like, have we seen money flow out because their performance has been mixed, as you say?
Over the years, we have seen some money flow out. They've also returned a little bit of capital last year because they NIR believes that they manage too much money and they're not going to be able to have good performance with it. They had $100 billion. Now they're down to 75. Some of that was also because of last year's loss. They lost many billions just on losing money.
How do people feel at Bridgewater right now? Like, are they optimistic? Are they worried? Are they interested? Like, how's the talent pool feeling?
I think some people are feeling better because of what I described as more people being able to really be involved in the managing money part of it. Mm-hmm. And I think some people, there's been a whole issue there about NIR promoting two people at the firm to senior positions. One was his former romantic partner and her former fiance. What? And I think some people are a little bit unhappy about that. So I think it's mixed.
So, okay, I guess the bottom line here is, $75 billion assets under management. They have to turn performance around. They're a big macro fund. Have they articulated any strategy how they're going to improve performance?
Cutting assets. They are going to lean more heavily into AI and machine learning. They do have another long-only business, and they're going to add things to that. They're going to do more geographically focused things and sustainability funds and.
Oh boy! And Ray Dalio is just out there. Ray Dalio is just out there speaking on every panel.
On all the things. Yeah. Paul was so gentlemanly and avoided that conversation. But wait, what happened? They promoted who with what and how? What? A girlfriend? What?
You buried the lead.
She did. Wait. So they promoted. Who?
Oh, so there was a woman who NIR had a 4 or 5 year relationship with, and they fired some senior people, and then she and her ex-fiance were promoted up into that job.
Hey.
I don't know where to go from there.
It's a hedge fund business.
Okay, but that's okay.
That's how they roll.
Okay.
I don't know. Maybe no HR oversight there. Catherine Burton, thanks so much for joining us here.
Loose
Catherine
requirements.
Burton, senior hedge fund reporter for Bloomberg News. Got the big take story today, and it's got the green B, which means it's exclusive. It's good stuff. But the big take stories, always great stories, in-depth reported. Some really cool titles here. You can go to bloomberg.com/bigtake to find them, or if you're on your terminal, you can go NI/Big Take, and that's where we get a lot of our deep reporting, a lot of good stories coming out every day from our friends at Bloomberg News. Looking at the markets here, S&P pretty much down about 0.2%, the Dow off about 0.5%, Home Depot pulling that down, I noticed, and NASDAQ just up fractionally here. But let's get to the yield space. That's where we're seeing some movement here. The 10-year Treasury up 11 basis points, 4.31% on your 10 years. That's what
Good news, bad news.
Yeah.
I know equities aren't going anywhere really, but we did see rotation lower in the equity market when we got that positive ISM. First expansion since 2022 from July. This is Bloomberg.
your company news headlines on Bloomberg Radio.
Yeah, I'm John Tucker in the newsroom with a look at some of the company stories we're following. United Airlines asking pilots to take unpaid time off next month. They're citing late arriving aircraft from Boeing. This according to a note sent to pilots and seen by CNBC reporting this. Another example of how Boeing's customers say the manufacturer's production problems and safety crisis impacting growth plans for these individual airlines. The offer comes after United and other airlines in recent years have clamored for more pilots when the COVID-19 pandemic travel slump ended and demand started to surge. And this one comes from the Journal. Behind the blockbuster success of drugs like Ozempic and Wegovy from Novo Nordisk, a less noticed phenomenon. Some people don't lose much weight on those drugs. There's wide variation in weight loss on these types of drugs called the GLP-1s. Doctors say roughly 10 to 15% of the people who try them are so-called non-responders, typically defined as those who lose less than 5% of their body weight. These patients, according to the Journal, citing doctors, don't experience enough appetite reduction to result in significant weight loss. Doctors believe some people might be resistant to the drugs as a result of genetic differences. And new quarter, so Levi Strauss, PVH, Dave & Buster's, companies behind familiar brand names, they're going to provide a preview of household spending trends for the rest of the year. They report earnings this week, and despite strong holiday sales that bolstered earnings for the likes of Ralph Lauren, shoppers are running out of spending runway as borrowing costs and prices remain high. And that's a look at some of the company news that we're following today. I'm John Tucker.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. I'm Alex Steele alongside Paul Sweeney. We are here live in the Interactive Broker Studio right here in Midtown Manhattan. You can also catch us on YouTube. You're listening to the Bloomberg Intelligence Radio Show. We have our top analysts covering all the top news worldwide. They cover like over 2,000 companies in 130 industries. We also cover world and national news. And for that, we go to Michael Barr. Michael?
Thank you very much, Alex. Paul. John Cruz in Baltimore have started cutting the collapsed Francis Scott Key Bridge into pieces. They've already moved tons of debris during a 24/7 operation. However, the weather is slowing down operations temporarily. Church services and masses were held across Baltimore on Easter to remember those who died in the bridge collapse. Reverend Aka Walker at Sacred Heart of Jesus Church remembered the 6 construction crew workers who were on the bridge and presumed dead.
Yes, we can rebuild the bridge, but we also have to look at the way in which migrant workers are treated and how best we can improve their situation as they come to the United States of America to make the United States of America a better place.
2 other workers survived. Starting today, fast food workers in California will make $20 an hour minimum wage. This woman works at a Jack in the Box in Folsom.
I was super excited. I mean, imagine, getting paid the minimum, just 15. And, I was working a lot of hours and still making basically no money.
Meanwhile, this man owns a Cinnabon in the Bay Area.
I want to do right by my employees, and I want to pay them as much as I can. But this bill, AB 1228, has really hit our operations hard.
Democrats in the state legislature say that many of the more than 500,000 people who work in fast food restaurants are not teenagers earning some spending money, but adults working to support their families. The Final Four is set in the men's NCAA tournament. North Carolina State takes on Purdue. UConn takes on Alabama, and it's a big time at North Carolina State because for the women, they are also in the NCAA Final Four. They'll face undefeated South Carolina. The remaining 2 open spots will be filled tonight. LSU against Iowa. USC will play UConn. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Paul, Alex, John.
All right. Thank you so much, Michael Barr. Stay in sports for a second, Paul, because here is an article that's reading pretty high in the Bloomberg terminal. So Travis Kelce and Patrick Mahomes really want Kansas City voters to approve a tax that would raise as much as $2 billion for 2 stadiums. They made their appeal in an ad encouraging Jackson County, Missouri residents to vote yes on an April 2nd ballot measure to renew a sales tax for another 40 years.
The revenue would fund the relocation of the Kansas City Royals baseball stadium into a new ballpark downtown so the NFL's Chiefs can expand into space now occupied by the Royals at the team's joint sports complex. My question is, and I don't know this, Kansas City, Kansas, Kansas City, Missouri, who owns like the team? Like, where's the team? I don't know anybody from that part of the world.
Well, New York Jets, New York Giants,
Yeah,
New
but, like-
Jersey, New York.
Yeah,
Kansas City,
but
is
the
that
difference
similar?
is you literally can walk across the street and be in Missouri versus Kansas.
Yes.
So that feels
Say
different
who?
than having to pay a toll.
Sports teams are in Missouri. Okay, now if somebody is in my ears explaining this to me, do I care? Like, if I'm do the Kansas people think differently than the Missouri people in Kansas City?
I don't know. Do they? John
don't know.
Tucker? He knows things. This feels like something he would know about,
I
like
know.
history of the people
Yeah.
for the colonialists for Missouri versus Kansas.
So you stick to Kansas City right on, I guess, the state line between Kansas
basically,
and Missouri?
So my husband is a professional playwright. He just had a play there in Kansas City, Missouri. And when he was there for rehearsals, he was like, look at me. And he's on the phone with me. He's like, I'm walking across. I just walked across the street and now I'm in Kansas. And he like put that state on
I
his
did that
bucket
in
list.
some little town in Tennessee and Virginia. What's the way they have the racetrack there? The NASCAR track. I can't think of it off the top of my head. Southwest Virginia. But anyway, so they want to raise some. They need some more tax dollars in Kansas City to fund some new stadiums there. Who doesn't like a new stadium?
Probably the
People that don't
taxpayers who
wanna pay the
don't want to pay the
taxes,
taxes and say that the owners who have a lot of money should do it. I mean,
Exactly.
you
I-
can see
I
both.
agree. I'm with
see
you.
the points. All right. Coming up, Paul and I will dissect the market even more. Second hour of Bloomberg Intelligence Radio is up next. Stay with us. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Lee Klaskow, Bloomberg Intelligence, Senior Transport, Logistics, and Shipping Analyst. Get the latest on UPS and FedEx. We got some deals happening there. They're working with the United States Postal Service, so see what's happening there. I just want my packages to get delivered like next day. We're also going to check in with Christina Hooper. She's Chief Global Market Strategist at Invesco. Get her market call. And then we're going to go down to Miami. Mike McGlone, Miami Mike, Bloomberg Intelligence Senior Commodities Strategist. Talk about gold, all-time high. And I'll tell you, folks, if you've been listening to this program for 5 years, Mike's been saying, buy gold, sell everything else in the commodity complex. That's been pretty good strategy.
Except
there.
Bitcoin.
Right, yeah. He likes the Bitcoin. Anyway, let's kick things off with John Tucker. He's long gold, I'm sure. What do you got?
Oh, yeah. Investors just booking profits from one of the strongest first quarters for the S&P 500. And now we start the new quarter with the major indexes mixed to lower right now. Real estate among the biggest drags in the S&P 500. Best performing group there belongs to communication services, and that's where you're going to find shares of Google parent Alphabet and Meta Platforms, both of which are higher. Meantime, Peter Scheer at Academy Securities says a change in stock leadership may be in the offing.
We could see a rotation. Unfortunately, I think this time, unlike November where we saw the rotation with strong gains for both, this time I think we might get tepid gains in the Russell 2000 and a small pullback in the NASDAQ 100.
And meantime, today's blowout manufacturing data further affirming the pullback in traders' expectations for rate cuts from the Fed this year. They've scaled back their outlook to even fewer rate cuts than the 75 basis points projected by the Fed in its dot plots. Right now, the S&P 500, 13 points lower. That's down 0.25%, 5240 on the index. The Dow Jones Industrial Average down 230 points. That's a decline of about 0.6%. The NASDAQ 100, it is higher, 7 points higher right now at 18,262. And as far as Treasury yields, the 2-year yield right now, 8 basis points higher. That's at 470. The 10-year, 11 basis points higher. That is at 4.31%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right. Thank you so much, John Tucker. Really appreciate that. So we do have some things on the move, even though overall it doesn't feel like a big move, news day or anything like that. But we have gold at a record high, so that'll be fun to talk about. So Jess Menton is here. She covers everything equities for us for Bloomberg News. Jess, what is on your mind today? As the overall index is kind of like, whatever.
Right. If you look more broadly for the S&P 500, seems like it isn't going too far here, but also just the caveat, it is coming off of 5 consecutive months of gains. And more specifically, I did a taking stock column about this last week. When you do
of course you did.
I have another one tomorrow coming
I
too.
read
So
them
be
like a
watch
Bible,
out for
okay?
that. But it's very rare to see specifically the gains overlap from November through March, just because typically you have the year-end tax harvesting either in when you see what happens toward the end of December. So actually that was the first time we saw that since 2013. So that was only the second time this century that we've seen that instance, and only 11 times since 1950s. That's something like that has happened. But nonetheless, when you look at today, though, you want to see what's really driving things. Take a look at what's happening with gold miners specifically. Not surprisingly, when you do see gold trading at a record here. So GLD
Who wrote about that today?
Right.
Just
the SPDR ETF that tracks the exchange traded fund there. So that is jumping after the precious metal did rise to a record. So tied to those indications that the Fed could be closer to cutting interest rates, but I'll give the caveat. We did hear from Fed Chair Jerome Powell on Friday that pushed back a little bit against that, but still said overall, if you're looking at the Fed's preferred gauge for PCE, that it still is headed in the right direction there. So more specifically, if you are looking at some stocks under the hood here, GOLD is the ticker symbol for Barrick Gold. If you look at this, that stock's up about 0.7%. Another one I'm keeping a close eye on, Royal Gold, RGLD is the ticker symbol on this too, also higher. And then of course,
That's a royalty company.
Yes, it is. It is royalty
I'll
company.
explain. It's a royalty company.
It
so
is.
It's a different kind of exposure. So it has a little bit more beta.
Right. So Barrick Gold is a gold miner, and then Royal Gold is a royalty company. And then if you look at Van Eck Gold Miners, GDX is the ticker symbol on this, up close to 1% here. And what's interesting about this too is gold is up about 8% year to date, while gold miners are up just about 3%. So over the past month, gold's been up actually double digits, just around 10%, while miners are up around 20%. So the question, kind of wondering if miners end up catching up, or how does sort of caveat works there, and if whether that'll be rectified or not. But that's something that is moving underneath the hood there, Alex, this morning.
All right, Jess, thanks so much. Really appreciate it, Jess Menton, joining us. And I read all your stuff. It's religious. It's kind of what I do.
So that's what I like to hear, guys.
All right. So the other news that's interesting is UPS as well as FedEx. So two things to watch. One, FedEx won a contract to be the cargo carrier for the USPS. FedEx, on the other hand, failed to come up with a deal, a container deal for the government as well. So a little bit of a divergence between the two. So who do we go to? Lee Klaskow, Bloomberg Intelligence Senior Transport Logistics and Shipping Analyst, who was off last week during the biggest shipping logistic nightmare that we've seen in quite a long time.
You timed that nicely.
Yeah, Lee, did you get a vacation or not so much?
Not so much. I got woken up pretty early. I was on West Coast time, so it was a fun day for me.
Yeah, I can imagine that.
Hence the beard now.
Hence the beard. He just got a lot older over the last week or so. So there's a lot to kind of get through. Let's get to the positive UPS news about being that cargo carrier for USPS.
Yeah, so, this is somewhat of a surprise. I think most people were expecting that FedEx would lose maybe about half of that business, but they ended up losing all of it. It's about $1.7 to $1.9 billion in revenue. Makes up roughly around 4 to 5% of their express business, maybe 2% of their total business. So it's a big loss for FedEx. And, while FedEx is losing, UPS is gaining. What's great about this is maybe not so much the revenue and the yields that it provides. It's the stability of the freight that it's going to be getting into its network. And when you have any sort of a freight network, you want equilibrium. You want to be able to predict what you're going to need in terms of resources, and this provides a good level set of predictability for them, and they can build density onto these routes where the U.S. Postal Service will be leveraging.
Why is the Postal Service making the switch?
That's a great question. They were negotiating with FedEx. I guess the two parties couldn't come to a conclusion in terms of an agreement, so therefore they just decided to part ways. One would guess that this is maybe not the most high margin business for whether it's UPS or FedEx. But again, I think there is a benefit to having this because it does create a lot of density in their network.
Let me ask a silly question. When I'm looking to mail a package, the United States Postal Service does not even come into my mindset.
Oh, God, no.
No.
Whoever wants to go to a
who
post
still
office?
uses the U.S. Postal Service versus FedEx or a UPS store that's right next to the Starbucks in town? I can go, get my cafe mocha there
All
and
the
all that kind of
things,
stuff.
yeah.
I'm not going to the post office. Who uses a post office these days?
I mean, I do. I guess I'm a
You
boomer.
do?
But
You know better.
I do sometimes. But the reality is the Postal Service, obviously we're not sending letters to grandma anymore. But, what we are doing is we're ordering stuff online. And the U.S. Postal Service provides a lot of the final mile delivery. So you might be ordering from a department store or, a .com e-tailer. And, they might be using UPS and FedEx for the line haul, but they might be leveraging the Postal Service for that final mile delivery because the Postal Service, at the end of the day, has to go to everyone's address, and it's a cheap way to do it. And as more and more people are willing to, maybe you don't need that T-shirt overnight. You can wait a couple days. Injecting that freight into the Postal Service makes sense. And Amazon is a big user of that final mile delivery as well.
My daughter does send letters to her grandmother.
Nice.
I'm just putting that out there. On the flip side, and I should point out, they mentioned the margin part of it. So we talked to the UPS CEO last week on television, and their whole pitch is that going forward, they want to focus on margin and pricing over volume. Does this fit into that strategy?
Yes and no. So yes, because so what they're going to be focusing on are verticals like small to mid-sized shippers, and those shippers come with very high margins relative to large enterprise companies that are out there. So they're going to be really focused on that type of business. But what the volumes from the Postal Service brings is a level of density that you can leverage, because it's all about operational leverage, right? No matter what you are in transportation, operational leverage is pretty high because you add like one more piece of freight, that piece of freight tends to have higher margins than the first 20 pieces of freight. And so what this will do is this will probably help them provide a base level of cost coverage and a profitable cost coverage at that. And then all these additional volumes that they're getting from higher margin might even carry higher incremental margins for UPS. So long term, it could have a very positive impact on margins. Near term, it might have somewhat of a negative mix shift, if you will. But we think that it does make sense for them to take this volume. And other verticals also that they talked about during their analyst day were the healthcare vertical, which tends to be highly profitable just because of the high touch nature and the high service level of that freight that goes through their network.
So, Lee, looking at the air freight companies, the FedEx, the UPS, how is business? How are volumes these days? Are they kind of peeled off from the pandemic, or how is volume?
Yeah, so we're coming off those highs that we reached during the pandemic when everyone was sitting at home and ordering toilet paper online, or at least trying to get some toilet paper online. We're back to a more normalized level. But the reality is that what the pandemic has done is it really increased that e-commerce penetration. It kind of brought the penetration forward by 3 to 5 years, which is a net positive. But we have to go back to this quote-unquote normalization process, which feels like a negative, but it's really not, because once we get this base, which I think we're building right now, we should see positive growth from here on out.
Well, now since you're back, I can also ask you about Baltimore. What is the news today? Like, where are we? I know that there's some salvage ships that are coming in to try and get the stuff off the bottom of the port. Where are we here? How's it going?
I'm not there, and my hands won't get dirty because I don't have those kind of hands. But it could take 4 to 6 weeks to clean up the channel area to get the port reopened. Obviously to rebuild the bridge, we're talking 2 to 4 years, probably closer to 4 than 2. And so that's going to take time. The freight that is going to be impacted can be moved to other ports, whether it's coal going to the port of Norfolk versus going out of Baltimore. A lot of roll-on, roll-off equipment, whether it's ag or commercial equipment, in addition to automotives, could go to Philly or New York, New Jersey ports. So there's going to be there's going to be other ports that can pull the slack. What you're going to see, because we track weekly rail volumes, you're probably going to see some volatility in the rail volumes, especially for Norfolk Southern and CSX, the 2 eastern railroads, and that might make earnings maybe a little lumpy or a little lighter than what expectations were. But this is not like a huge dislocation like we saw, whether it's during the pandemic, and it's probably even less of a big deal, if you will, than what we saw what we're seeing right now in the Red Sea in terms of the impact.
Mm-hmm.
I think this is really like from a supply chain standpoint, it's really a short-term negative impact where we'll find the new normal. I guess I do say that a lot in my job, what the new normal is, but we will find a new normal as freight finds other ports to go short term until the Port of Baltimore opens up, which hopefully will be in less than 2 months' time.
Hey, Lee, when you talk to your institutional investor clients, and you're talking about the transportation space broadly defined, where are people most excited? Is it the rails? Is it the trucks? Is it the marine shippers?
Yeah, so that's a great question. I don't really think it's on a mode basis right now. I think it's really by a company's story. You have Norfolk Southern, where you have a lot of activist activity going on there. So there's a lot of excitement about how that company can improve its margins. In the West, you have Union Pacific on the rail side, where you have a new CEO that comes in with a lot of precision scheduling railroading experience, and expectations are he's going to be able to improve margins. And then on the growth side of things in the rail industry, you have Canadian Pacific, Kansas City, which is the byproduct of a merger that happened last year, and they have some great growth opportunities because they're the only railroad that touches Canada, the U.S., and Mexico. And as you know, nearshoring is a long-term, slow but long-term secular growth story that we're looking at, and they're expected to benefit the most from there. And then broadly speaking, I think people are just waiting to see the truckload rate cycle start to turn.
Mm-hmm.
We believe it's going to happen this quarter. We believe we're bouncing along the bottom. What happened in Baltimore could kind of give a boost to certain kind of equipment types like flatbed equipment near term here, which could be a great base to work on positive pricing, which the truckload industry desperately needs.
Lee, before we let you go, on that point, we had the ISM manufacturing data coming in really strong, and it had been expansionary territory for the first time since July of 2022. It has been bouncing along the bottom and troughing for like 5 or 6 months. You're saying something similar for the transportation sector in some ways. Does it reaccelerate? Like, what does the upturn look like?
So the ISM index is probably a great precursor to less than truckload demand. So think companies like XPO, Old Dominion, even FedEx. FedEx Freight is the largest LTL carrier out there. Tonnage has been in decline, broadly speaking, and what the ISM usually is, it kind of leads demand by 3 to 6 months. So the fact that it inflected into expansion territory is a positive sign for the LTL space. That's how we look when we're looking at the ISM.
All right, Lee, great stuff as always. Appreciate it. Bringing it as he always does. Lee Klaskow, Senior Transportation, Logistics, and Shipping Analyst for Bloomberg Intelligence, coming to us from our Princeton studio via that technology the kids call Zoom, so that worked out for us. Just looking at the logistics, it seems like we're back to normalized logistics, getting our product from point A to point B, kind of back to where we were, I guess. I guess my question is, what happens to just-in-time inventory? Is that still a thing, or did people learn their lesson? Like, that just-in-time, that's a little too dicey. Maybe
but it's not like a huge buildup of inventory, right? It's like you have enough, but not too much, and kind of finding that sweet spot, as I feel like retailers have been trying to find for a bit, can be quite tricky. But it will be interesting. I know that we're writing off what happened in Baltimore in terms of logistics. I know we're doing that. There's space, there's capacity at different ports. Railroads have capacity, etc. We have to wonder, though, if it doesn't take any shorter than 4 to 6 weeks, do we have to rethink the disinflationary trend that we're seeing? Like not inflation, not something crazy, but just stops the decline. Anyway, these are just my Monday morning thoughts. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom of this Bloomberg Business Flash. We had some solid factory data today, reinforcing speculation that the Federal Reserve is in no rush to cut interest rates. As a result, the major stock averages right now mostly lower. Treasury yields are rising. In fact, we're probably at the worst levels of the session for the major stock averages right now. After the S&P 500 notched its 5th straight month of gains, it is down right now 20 points. Micron Technology, that is a standout, the best performing stock in the S&P 500. This after Bank of America raised its price target on the memory-focused chip maker to $144 from $120. And then you have Walgreen Boots Alliance. That is the worst performing stock in the S&P 500, down almost 6%. And Tesla shares among the most active, they are down 2.5%. Tesla has Wall Street a little worried about the quarterly vehicle deliveries. S&P 500 again, 20 points lower. That's down 0.4%. We're at 5235 on the index. The Dow Jones Industrial Average 255 points lower. And right now, the NASDAQ 100, 23 points lower. It has turned in the red right now, down 0.1%. And Treasury yields, they are rising. The 10-year, 11 basis points. That is up to 4.31 right now. The 2-year yield up 9 basis points, and that is at 4.71. Now we check the markets for you all day long. Right here on Bloomberg Radio, I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Again, heck of a first quarter for equity markets, up 10% for the S&P 500. Looking at that October low, up over just over 25%, so a big move just in the last 5 to 6 months. Have we gone too far? Do we still have more room to grow? Let's check in with Christina Hooper. She's a Chief Global Market Strategist for Invesco. Christina, again, a lot of people, I think, are kind of looking back at this first quarter we had and looking back to October and say, boy, that was a nice move. Now what do we do? What are you telling them?
Well, I think it's important to keep our focus on the longer term. Yes, it seems likely that stocks will take something of a breather after such a strong quarter and such a strong rally since October. But the reality is that we are still waiting for the start of rate cuts, which could very well be a positive catalyst for stocks. We also have very significant cash sitting on the sidelines that could easily start to move into equities as well as fixed income as rates start to go down. So what we're saying is don't overreact to the environment, but be well diversified, because we could very well see a rotation. For example, one more unnoticed development last week was the Russell 2000 surpassing the high hit in early March. And I think it's a reminder that there are opportunities outside of large cap U.S. stocks. If we go across the pond, if we look internationally, as well as if we look into the smaller cap space. But again, the key is to be well diversified across the major asset classes and within them.
So Christina, is that a value call? Or is that just own lots of different things because we don't know what form the economy will really take and what the Fed will do?
Well, I would argue that it's a call on expectations of what is going to happen later this year and next year. So what I think we're going to see is a rather brief and mild slowdown for the global economy, followed by a re-acceleration. And typically, asset classes discount these events before they happen, which is why I think we're starting to see improvement in small caps, why we're seeing a broadening of the stock market.
Does a broadening of the stock market include China? There's a lot of folks out there that say China, for a variety of reasons, is uninvestable. What do you think?
So I would argue that sentiment has gotten far too negative on Chinese equities, and it creates a situation in which we could see some very positive Chinese equity market performance with a little positive surprise. And an example of that is the recent data we saw, the PMI data. Better than expected, and of course, no surprise that we saw a positive reaction because Chinese equities have been oversold. There are opportunities there.
That's an interesting call.
Yeah.
How do you hedge? I mean, Do you go internal stocks, like small caps that might get a boost from any government stimulus, or is it you still want to own U.S. companies with exposure, just maybe we have to be selective on what kind of exposure, a la Apple?
I think there's a case for both, but certainly Chinese equities, getting in there, especially areas like China tech. I think there's significant potential there. I think what we're hearing from Chinese policymakers is a willingness to be, of an interest in being very business friendly, and I think there's upside potential there.
How about on the fixed income side here, just broadly speaking? Do I want to just stick with my 2-year Treasury at 4.7%, or do I want to go out and take some credit risk here?
So I think in this environment, with an expectation of a pretty soft slowdown, what I would argue is that it is a time to take credit risk and also move out in terms of duration, locking in rates, because we know what is likely to happen in the future in terms of rate cuts.
So is that a price appreciation play, or is it an absolute yield play?
It's a little of both.
Interesting. And is so how do I then think about the economy in relation to the Fed cuts? I mean, just today, right, we get that nice and hot ISM manufacturing data at the top of the 10 o'clock hour, and we see a pretty sturdy sell-off, particularly in the back end, like higher for longer, therefore growth will be impacted later, etc. How do you view that?
So I think there was a real overreaction on the part of the market to today's data, and understandably so. There are a lot of jitters out there. We are certainly getting conflicting messages in terms of Fed speak. But the reality is, I don't think anything in that print today changes my view that we will see a rate cut before the end of the second quarter. Yes, hotter than expected, but we didn't see anything dramatic. And in fact, employment remains tepid. That's sub-index. The price sub-index went up, but it's largely a result of commodities. So I understand why why we're seeing the reaction we are, but I don't believe that's going to change the Fed's mind. I mean, we've seen very, very significant progress on disinflation, and core PCE on Friday underscores that.
So, Christina, I'm just thinking about an environment where interest rates are coming down. What does that mean for real estate?
I think that takes some of the pressure off real estate, and we're likely seeing a bottom for the real estate market. Certainly for refinancings that are to come, that will certainly be a positive. And we also know, of course, that there is a pretty strong correlation between real estate prices and interest rates. So I think this is a very positive development. The sooner the better in terms of rate cuts starting for real estate.
You sound like a very engaged Goldilockser. I'm just going to coin that term, Goldilockser. What are you then most worried about? Because if we go with the way you're talking about, this could be very good for many different assets, et cetera. What do you worry about?
So I worry about the Fed weighing too heavily the ghost of Paul Volcker. I worry about the Fed having egg on its face from being late to react to higher inflation, and as a result, being more hawkish in rate cuts this year, or deciding to forego them, or having a reduced number. I think that could be really problematic. First of all, because markets are expecting some level of rate cuts this year, but also because what we know is that there are long and variable lags between when monetary policy is implemented and when it shows up in the economy. So we could still very well see damage from what the Fed has done thus far. So to compound that by keeping rates at high levels for longer would be a mistake, in my opinion.
All right, Christina, thank you so much. We appreciate it. Christina Hooper, Chief Global Market Strategist for Invesco. Alex, just seeing a Bloomberg story crossing the tape here. Trump Media lost $58 million on $4 million in sales last year. So I had no idea what the size of the company was. I guess $4 million of revenue resulted in a net loss of $58 million. Yet, the company has a stock market value of $7.5 billion. How about that for a nice valuation?
I don't get it. I mean, I understand why people want to go buy DJT,
right?
And then what it's and being associated with President Trump and all the fervor, etc. But I don't get, if you look at the numbers, why that makes any sense whatsoever. Particularly when you know that the biggest shareholder, Donald Trump, will at some point sell shares for money.
Yeah,
I don't get it.
Yeah, the stock it's down 15% today, but it's up 200% year to date. It's up 273%. On a trailing 12-month basis, but they had a filing this morning which provided that financial detail. So again, $4 million of revenue, $58 million net loss last year. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, and John. A growing list of grievances among those between the ages of 18 to 29 is a concerning sign for President Biden as he seeks a second term. People in that age are more than twice as likely to cite the economy as their top concern compared with older adults in a recent Gallup data. Here's more with Bloomberg's Laura Davison.
The young people are just not feeling as good about the economy as their older peers. So young people are most likely to cite the economy as their top issue. And they're looking at things like they have higher levels of debt than older people. The inflation has affected them much more. They have lower wages. So everyday price increases on things like groceries affect them more. They're also more likely to rent. So the steep increase in rental prices that we've seen recently have affected them more.
Bloomberg's Laura Davison. President Biden will visit Baltimore this week to get an update from officials on recovery efforts following the collapse of the Francis Scott Key Bridge. Meanwhile, the 4th Navy crane is set to arrive to help clear the massive wreckage. Dallas police want to speak with Kansas City Chiefs wide receiver Rashid Rice about a multi-vehicle crash that left 2 people hospitalized over the weekend. Police say 2 sports cars, including a Corvette registered to Rice, were racing on the North Central Expressway when they lost control and caused a chain reaction crash involving 4 other vehicles. Immediately after the crash, police say the people inside the sports cars walked away from the scene. Attorney Mark Lenahan represents a hospitalized victim who was just heading to meet friends for dinner.
2 vehicles going way too fast on a highway at 6:30 at night, filled with families and everybody else just trying to get home and get to meals and be with loved ones, doing their daily business. These people thought they were too cool for all that.
Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom. With this Bloomberg Business Flash, we have data, and that appears to be in the driver's seat for investors today. Manufacturing unexpectedly expanding for the first time since September 2022, while input costs climb. So that's pushing Treasury yields higher and stocks lower for now. The betting is the Fed would be less likely to cut rates starting in June. The June rate cut odds, in fact, falling below 50%. Later this week, a report expected to show employment gains continued in March while wage growth moderated. Right now, 9 of the 11 major industry groups in the S&P 500 are lower. You have real estate. That is the biggest drag. Gold hitting a record price. And Ed Al-Husseini at Columbia Threadneedle says, you know what? Commodities can push even higher.
If you look at just the span of the last 6 months, growth expectations for the U.S. have doubled. Right? I think the Bloomberg survey has gone up from below 1 to in excess of 2%. This is a fantastic backdrop for the commodity space. And a lot of this recovery has been led globally by manufacturing stabilizing and now potentially accelerating. And we saw that with PMI data.
Right now, oil rising on signs of better than expected demand. You have NYMEX crude, that's up 1.2%. Brent, the international benchmark, up 0.8, 87.71 a barrel. S&P 500, 18 points lower. That's down 0.3% right now, 52.36 on the index. The Dow Jones Industrial Average, 262 points lower. The NASDAQ, 108 points lower right now, 18,247. The two-year yield, 9 basis points higher. That is at 471. And the 10-year yield, 12 basis points higher. That is at 432. Those yields keep pushing higher. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Paul and Alex.
All right, John Tucker, thank you so very much. You're listening to Bloomberg Intelligence Radio. I'm Alex Steele here with Paul Sweeney. It's Monday. Happy Monday. We made it through the weekend. We are live from Interactive Broker Studio right here in Midtown Manhattan. We are also live on YouTube. We cover all the news with our top Bloomberg Intelligence analysts all around the world. They cover over 2,000 companies and 130 industries worldwide, and one of them covers everything commodities. And we're talking Bitcoin, we're talking gold, we're talking cocoa, we're talking oil, you name it, he covers it, and that's Mike McGlone, Bloomberg Intelligence, a senior commodity strategist standing by. Mike, I know you're excited. We're going to talk about gold. What is actually driving gold? I heard someone talking earlier about, it's central bank buying. It's like, come on, man, really?
Well, Alex, as a commodity person, you know I do appreciate talking about a commodity that is making record highs and potentially will continue to make new highs, and obviously that's gold and U.S. dollars. But it is true, according to the World Gold Council, their last report, they used the word colossal to describe central bank buying of gold. And what's significant, it's offsetting significant selling in exchange-traded funds, ETFs. The thing is, exchange-traded fund holdings now are about near that high from 2012. They've dropped 25%, and it looks like gold has some pretty sound footings, particularly if we at some point get a little back up in the stock market.
And folks, if you have access to a Bloomberg terminal, BI space COMD for the commodities dashboard, everything you need to know about the broad commodity space from Mike McGlone and his team. So why are central banks buying gold?
2 words. It starts with unlimited friendship between President Xi and President Putin in 2022, and then a few wars that have happened since then. But since then, a lot of central banks, some might be considered the axis of antagonists, are accumulating gold. We mentioned China, and kind of getting away from the dollar. So that's a key fact. But it's also what gold doesn't have that other commodities are under the pressure of is that high price cure. When commodities spike like they did to 2022, it brings on massive supply and cuts down the demand. In gold, it doesn't happen that way. So now we have this situation where the world is kind of worried about the dollar. It's accumulated the next best proxy to the dollar, and also that's part of what's pushing up Bitcoin, because the way I always say about gold is analog, it's great, but in a world going digital, maybe some Bitcoins in that space. But overall, I'm bullish gold. I think what it's done now, it's probably putting a good floor around the old ceiling around $2,000 an ounce, and I think going to 3,000 is a matter of time.
Wow. Okay, so, I mean, just wow. But what actually gets us there? Like, what has to happen in other areas of the market that gets us to that spot?
Yes, I think the key thing, Alex, is the first bridge, and everybody's waiting for is that first little drawdown in the S&P 500. Since that bottom in October, it's been up almost 30% with only 1 week that was down 1.5%. That was the most. Now, gold's had a correction, Bitcoin's had a correction, so I think that's what everybody's kind of waiting for, how the market reacts when we get a normal drawdown. The key thing is it's outperforming. It's actually about the same level. It's up about 10% this year as the S&P 500 total return. What's unique is since the end of 2021, which is before that big event in 2022, gold is outperforming the S&P 500 total return by about 5%, and it's with lower volatility. So when you're a money manager, and also it's so much out of favor. One thing we learned about running money is when something's way out of favor, maybe you should look at it, and ETF holdings are showing gold way out of favor.
How about WTI crude oil? We're over $84 a barrel. I don't know what John Tucker's paying for gas at the Wawa on Route 36.
And demand has been really good.
So what's happening with oil here?
Oil is, I think, oil and copper, the most macroeconomic commodities, are near the upper end of their ranges. And look at it this way: if you're running commodities right now, and you see on a 1-year basis, S&P 500 total return is 33%, and your commodities spot index is -3%. Yes, crude oil is picked up. Your biggest value at risk is a little correction in the stock market. So oil will do fine, I think, but to me, it's near the upper end of the range. And the key thing to look at is the rest of the world's having a problem. And the key thing that's really made pressured oil since the 2008 peak is that massive excess of supply of the U.S. and Canada. It's accelerating. Almost 6 million barrels a day now of excess supply out of U.S. and Canada. That's liquid fuels, including ethanol and things. That's accelerating. And here's a little anecdote: OPEC spare capacity is now around 7%. It's had a pickup, and it's typically around 5%. You see what's happening there. I think this is more short-term, range-bound for commodities, but more breakout for gold.
No, that's what I was going to wonder about, stay with oil for a second, is the curve reflecting that? Because as OPEC Plus pulls back, the more they do have in spare capacity, as you say, which basically means if they need it, they got it. Are we seeing that reflected in the curve structure?
Yes, well, it's still in backwardation, which means the further our prices are lower, which typically means it's more of a short-term phenomenon. The peak in backwardation was in 2022 or so. Remember, that's when natural gas peaked in backwardation. And I think that's why I like to go to natural gas, because it's now in a pretty steep contango. And to me, it's a matter of time crude oil follows natural gas and goes down to near its break-even cost in the U.S., which is around $55 a barrel. Now, people have heard that. I've been early. I've been wrong. But that's typically what it takes after a big high price cure. You need to get the low price cure. And right now we do have a bit of a significant geopolitical bid under crude oil.
And also contango, it just means that back end contracts, those prices are higher. So oil further out is higher than what we're at right now. That's what we're going to get to in contango. I'm just Alex explaining right now to John Tucker and Paul Sweeney.
The opposite of backwardation.
Which is that the current price is higher than the prices later on.
Wow.
We got that? We're good?
Got that. Yeah. I mean,
to be fair, I have to look it up every once in a while to do a refresher, but that's kind of the net. So your favorite commodity, gold? What about the softs, the ags?
I think you're going to see a seasonal bounce in corn and soybeans, but Alex, they were so oversold. It's seasonal, but once we get the growing season, and unless we get a severe drought, they're going to go back down to their cost of production. In corn, that's below 4, and soybeans is probably around 10. And of course, if you want to tilt over the cocoa just got to near 10,000. I think it's going to do what it did near 5,000 in 1977, put in a high that might last for a couple decades. It's just a question of exactly where that happens. It's usually how it works. The high price cure kicks in.
Dang,
That's commodity talk.
I like my chocolate though. This hurts. This hurts on like a
Easter's
deep level.
over. I mean, come on.
Do you think I just eat chocolate on what? Hello? Do you
Mike
not know me
McGlone,
but at
thank
all?
you. Mike McGlone, senior commodity strategist, Bloomberg Intelligence, breaking it all down, the hards, the softs, all that kind of stuff. We didn't even get to Bitcoin. I mean, that sucks. That commodity, I don't know, currency, commodity, I'm not sure what it is.
Okay, so the prediction I
3%.
heard from Mike was $50 to $55 a barrel oil.
Yeah. To get to the
He's
supply
been a bear.
cost. Yeah.
Yeah.
So he's a little bearish there.
Yeah.
We'll see.
Consistently bearish, though. So, I mean, we'll see how it
He's
plays
been
out.
early. He's been early, but doesn't
Yep.
mean it's not going to happen.
Yeah, we'll see. S&P 500 off 1/3%. The Dow off 0.6%. The NASDAQ pretty much unchanged on the day. The 10-year Treasury, that's up 12 basis points, 4.32%. So some big moves there in your 10-year Treasury. WTI crude oil up 1%, $84.10. Bitcoin off 3%, 68,700 on the cryptocurrency. We'll have more coming up. This is Bloomberg.
your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Some of the company stories we're following. AT&T saying the personal data from about 73 million current and former customers was leaked onto the dark web. So it's had to reset passwords, 7.6 million passwords. The data includes former customers spilled onto the dark web a couple of weeks ago, according to AT&T. This includes the personal information like Social Security numbers. It appears to be from 2019 or even earlier. The source of the data is still being investigated, and it's not known whether it came from the company itself or one of its vendors. The recent data leak comes about 3 years after a hacker known as Shiny Hunters claimed to have stolen the personal information about 70 million AT&T customers. Eiger Biopharmaceuticals. This is a company developing therapies for rare metabolic diseases. Well, they have filed for bankruptcy protection. Publicly traded, Eiger listing $38.8 million in assets and $53.1 million in liabilities in the Chapter 11 petition that was filed in Dallas. The bankruptcy filing will give Eiger time to discuss restructuring options with its creditors. The company develops therapies for hepatitis, Delta virus, and other serious diseases. This one from the Journal. Google plans to destroy a trove of data. It reflects millions of users' web browsing histories. It's all part of a settlement of a lawsuit that alleged the company tracked millions of users without their knowledge. The class action was filed back in 2020. It accused Google of misleading users about how Chrome tracked the activity of anybody who used the private incognito browsing option. And that is your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday, everybody. Hope everyone had a nice, long holiday weekend. I'm Alex Steele here with Paul Sweeney. You're listening to Bloomberg Intelligence Radio. We are live from Interactive Broker Studio right here in Midtown Manhattan. You can also check us out on YouTube. We cover all the top news for you and with you with our Bloomberg Intelligence analysts that cover 2,000 companies in 130 industries worldwide. We also give you unparalleled world and national news with Michael Barr. Michael?
Thank you very much, Alex, Paul, and John. Alex Murdoch has been sentenced to 40 years in federal prison for stealing from clients and his law firm. The 55-year-old disbarred attorney is already serving a life sentence without parole in a state prison for killing his wife and son. He also pleaded guilty to similar financial crime charges in state court. Before his sentencing this morning, Murdoch apologized again to his victims and blamed drug abuse. A judge says his schemes are too complex for an addict. Israeli Prime Minister Benjamin Netanyahu is still in the hospital after a hernia operation as tens of thousands of protesters call for new elections in Israel. Israeli officials say Netanyahu's surgery, which was held under general anesthesia, was successful, and he is resting in the hospital. Professor Alan Pekarsky is with the Hadassah Medical Center.
The operation of the Prime Minister, Mr. Benjamin Netanyahu, was completed successfully. He's awake. He's talking to his family.
Professor Alan Pekarsky. The Final Four is set in the men's NCAA tournament. North Carolina State faces Purdue. UConn takes on Alabama. The women's team at North Carolina State is also in the NCAA Final Four. They will face South Carolina. The remaining two open slots will be filled tonight. It's Angel Reese and LSU against Caitlin Clark and Iowa. History, history, history. Clark on competitive passion.
Yeah, I think for me, my competitive passion is just all about the game and what fires me up and what fires my team up. I think that's what I'm focused on. I think I play with a lot of emotion, but I think our team is mostly focused on celebrating each other. That's what we've always been about.
Meanwhile, Reese says, okay, I'll play the villain.
I just wish people realize that, once I get between those lines, it's no friends. I have plenty of friends on the court that I talk to outside of the game, but when I get between those lines, we're not friends, we're not buddies. I'm gonna talk trash to you. I'm gonna do whatever it takes to get in your head the whole entire game. But after the game, we can kick it. I don't think people really realize that.
Global news, 24 hours a day. By the way, USC plays UConn. 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. I'm so excited about this game. Paul, Alex, John.
I don't know anything about sports, so you can say sports words.
Sure.
Are you excited about this game?
Yeah, I am.
Okay, great.
It'll be fun.
I'm sorry, Michael, but I'm disappointing you. He's like tossing the ball. He's like, pick it up, run with it. It's sports. And I got nothing for you, man. I got nothing for you.
All you need to know is between Angel Reese and Caitlin Clark is going to be a meeting in the ladies' room, man.
Yes.
This is what this is going to go down to. Because they have this. Remember the shot last year where Clark held up her ring finger in front. Reese held up her ring finger in front of Clark and started pointing to it because they had the ring.
No, but go ahead.
Okay, well, that was the story right there. That was it.
Okay, so
I'm telling you that this is going to be a great game. I want to see this.
Okay.
Good.
Yeah.
You're fired up now?
Yeah, I'm pretending.
Okay.
On air, but I appreciate it. One story that is not getting me fired up, and my interpretation of it is higher airfares. And this comes from CNBC. Is that apparently United is asking pilots to take some unpaid time off, citing Boeing's delayed aircraft. So they were in line to get a bunch of aircraft from Boeing. Obviously, all of that is delayed, and they're asking them to take some unpaid time off next month. I don't know. And isn't that like taking capacity out, therefore thus pay up?
Yes. United was contracted to receive 43 Boeing 737 MAX 8 planes and 34 MAX 9. They're only going to get 37 and 19 respectively. So fewer planes, fewer capacity. I don't need as many pilot hours, presumably.
Yep. I mean, that doesn't feel good for the consumer, maybe. Have you flown on some of the older United versus the newer? Man, that is a big difference.
Yes, it is. Yeah, you never know what you're getting.
You never know.
No. So, but we'll see. I mean, they get me there one piece. That's all. That's all we can really
That is 100% yes, what we care about.
Coming up, Balance of Power. Kaylee Lines today, bringing you the latest from Washington, D.C. Balance of Power. That starts right now.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
Welcome to the fastest show in politics. This is Balance of Power. Happy Monday and welcome back from the holiday weekend in which a lot happened that we have to discuss, including a news conference from Israeli Prime Minister Benjamin Netanyahu talking about a plan to move Palestinian civilians out of Rafah and then go in to attack Hamas. We'll have more on that with Bloomberg's own Nick Wadhams and discuss the political ramifications for President Biden with Pat Dennis of American Bridge and our signature political panel, Rick Davis and Jeannie Shanzano. Plus, almost a week since the collapse of Baltimore's Francis Scott Key Bridge, we'll look at the impact on shipping and the economy with Lee Klaskow of Bloomberg Intelligence and Bloomberg's very own Mike McKee, who will also have a look at all of the data we've gotten over the last few days. And with a look at how markets are reacting to that data, let's start there. Bloomberg's Charlie Pellet has a look on trading from New York. Hey, Charlie.
Hi, thank you very much. Kaylee Lines, and we are at the lows of the day right now with the S&P down 24 at 52.30. That is a drop now of 0.5%. Dow Jones Industrial Average down 309, a decline of 0.8%, while the Nasdaq Composite Index is down 47, a drop there of 0.3%. Stocks erase gains as solid American factory data reinforce speculation that the Fed will be in no rush to cut interest rates. 10-year, 4.32%, with a 2-year on this back to work Monday, 4.71%. Spot gold up $8.50 the ounce now to $22.38, up 0.4%. West Texas Intermediate crude up 1.4%, $84.29 a barrel. As for the overall market backdrop, Peter Cheer is Director of Macro Strategy at Academy Securities.
I've been kind of thinking about this market as really AI. Anything that's kind of been deputized into AI has been driving the market. But for the last week, all of a sudden, the Russell 2000 is a little bit better. I've liked the energy sector in particular. And I'm wondering now, people are starting to say maybe banking's okay, commercial real estate, biotech side is ups and downs. So we could see a rotation. Unfortunately, I think this time, unlike November where we saw the rotation with strong gains for both, this time I think we might get tepid gains in the Russell 2000 and a small pullback in the NASDAQ 100.
And you can can hear more of the conversation with Peter Cheer on this Surveillance podcast. You can download it wherever you get your podcasts. Donald Trump's social media business lost more than $58 million last year as revenue for the former president's Truth Social platform trickled in, contrasting sharply with the company's rocketing share price. Today, shares of his company lower by 18.6%. That ticker, by the way, DJT. Again, recapping here, stocks lower, S&P down 22, drop there of 0.4%. I'm Charlie Pellet. Balance of Power continues. Back we go to Washington. Once again, here she is, Kaylee Lines.
All right, Charlie, with a look at trading on what is the first trading day of the second quarter of the month, and of course, the week. And it's worth noting that before this week is out, we will mark 6 months since October 7th and the Hamas attacks against Israelis, and of course, the resulting war between Israel and Hamas, which is still ongoing as we speak. And of course, Israel Prime Minister Benjamin Netanyahu was the one speaking yesterday, held a news conference in which he talked about a plan to prepare to move more than 1 million Palestinians out of Rafah, that southern Gaza city, and then carry out an attack against the remaining Hamas battalions there. There is ongoing pressure, both internationally and potentially domestically as well, for a ceasefire deal with Hamas, as tens of thousands of Israelis were protesting over this weekend as well, calling for a new government. We want to break it all down now with Nick Wadhams, who leads our U.S. national security coverage here in Washington. He is joining me in studio. So, Nick, first of all, great to see you. Happy Monday. As we heard from Netanyahu over the weekend talking about how they're going to move more than 1 million people out of Rafah, can they realistically do that? How hard is that going to be?
I mean, that is the great question, and that's what the administration has really been pushing, because Prime Minister Netanyahu has said for many weeks, they intend to do this. The U.S. has been pressing and saying, listen, you don't need to do this kind of military campaign. We would rather see a campaign that relies on precision strikes targeting the leaders of Hamas, but a full-scale campaign like that, don't do it. If you do it, you need to give us a credible plan for what you're going to do with all these civilians who have fled to Rafah from the north. And so far, the administration says, they just have not seen any sort of plan. I mean, 1 million people is a lot of people to move. You're going to have to house them. You're going to have to feed them, provide medical care. Where do they go? They can't go back to northern Gaza, so do they go somewhere else? Egypt, is there going to be there's so many questions around this. And so far, this is a tension point between the U.S. and Israel that we just have not seen resolved for several weeks.
Well, speaking of tension between the U.S. and Israel, or perhaps more specifically between Benjamin Netanyahu and President Biden, we heard from Senator Chris Van Hollen, the Democrat from Maryland, speaking on one of the Sunday shows this weekend, who said Netanyahu, this is a quote, continues to essentially give the finger to the President of the United States, and we're sending more bombs.
Right.
Are we going to keep sending bombs in the face of the finger, Nick?
Chris Van Hollen has been one of the most outspoken U.S. senators on this issue, and he is pushing this idea of conditioning more military aid on humanitarian improvements from the Netanyahu administration. So this is not out of character for him. So far, though, no. The answer is the Biden administration has made clear that they are going to support Israel through thick and thin. There may be some effort on the margins or a broader diplomatic effort to try to shape this campaign, but I very strongly believe you are not going to see a situation where the U.S. suspends military aid along the lines of what Chris Van Hollen would want. That just the blowback would be so fierce, and it goes against everything we know about how President Biden sees this relationship.
So maybe there's limits to the pressure the U.S. realistically can apply on Netanyahu's government for that reason. But it raises the question of what domestic pressure Netanyahu may face, though, that maybe he's a bit more beholden to. Over the weekend, tens of thousands of people out calling for a new government, something, mind you, which the Senate Majority Leader Chuck Schumer himself called for just a few weeks ago. What does this do to Netanyahu's position and potentially his conduct moving forward throughout this conflict?
Well, these sort of protests are not necessarily a new thing. You saw a lot of this around the judicial reforms that his administration wanted to push through, and it took a long time for his administration to budge. The central tension there is, yes, you may have thousands, tens of thousands, hundreds of thousands of people on the streets in Israel, but his cabinet is so right-wing, and the pressures he's getting internally are moving in exactly the opposite direction. Drive a harder bargain, be harder against the Palestinians, hit them harder. So he's going to have to balance those two things. But the issue is the right-wing colleagues he has in the cabinet would be a much more imminent threat to his grip on power if he decided to reverse course. I mean, he would be gone in minutes. Whereas these protests, it looks like a big deal, but that's something he could reasonably withstand for quite some time. So you're really going to see a challenge in how he navigates on that. But the judicial reforms are a great example. It took a very, very long time for him to make any sort of movement on that. So I wouldn't expect to see anything happen really quickly here.
Okay, so that's the spot that the Israeli leader is in at this time. I want to talk, though, about another leader in the Middle East, the president of Turkey, Recep Tayyip Erdogan. There were municipal elections over the weekend, pretty unprecedented defeat where the opposition party actually gained ground in a number of areas that have been a stronghold for his governing party. What's happening in Turkey mean for broadly the conditions in the Middle East?
It's a great question because I think the issue with Erdogan is that he doesn't actually face any real challenge to his own power until 2028 when he would come up for re-election. So it's a blow, but is this going to shape or put pressure on him internationally in terms of his position to work as a power broker, his position in NATO, sometimes as an irritant? I mean, he is just sort of getting things back on track with the U.S. and NATO. They abandoned their blockage of Sweden's accession to NATO. So, this is someone who the U.S. and others, they may have their problems with him, but they feel that this is a relationship that can be managed. This sort of domestic pressure, I think, it's a big deal for him in terms of what's going to happen long term, but it's very long term. I mean, he doesn't face any real threat to his legitimacy until 2028. So certainly a foreboding, a warning shot, but he's also shown a great tendency in the past to be able to use the powers of the presidency to sideline his opponents. So he's got a lot of time to sort of pivot and figure out how to address this before he faces any real challenge to his power in a few years.
All right, Nick Wadhams, who leads our national security coverage here in Washington. Thank you.
Thank you
so much. Nick, of course, running us through domestic pressures that the Turkish president is facing, the Israeli prime minister is facing. Now let's talk about the domestic pressures that the president of the United States is facing as he, of course, campaigns for re-election. And there is a great deal, if you look at the primary vote, of those who are potentially not satisfied with his handling of the war between Israel and Hamas, and that has shown up in people voting uncommitted in Democratic primaries. On this subject, we want to turn now to Pat Dennis. He is the president of American Bridge 21st Century. Pat, thank you so much for joining us here on Balance of Power. We know that there is some dissatisfaction with a primary electorate in places like Michigan, for example, where there is a heavy Arab and Muslim population, as is with young people as well, with the way that the president has handled this conflict. What does he need to change moving forward in order to make sure those people actually are willing to vote for him in November?
Hey, Kaylee, it's great to be back. So these issues are some of the most difficult issues in American politics. And ultimately, I think what people want in a president is a steady hand on the tiller, somebody who's reasonable, somebody who can take, these problems, deal with them as they change, and, somebody that you can trust in there and not be freaked out all the time, which I think is in real contrast to Donald Trump's just like completely erratic leadership on foreign policy, but really on everything. But also the current chaos in the House of Representatives, I think, is also an incredible contrast to just how can we govern with these people? How can we govern globally with folks who can't even govern their caucus? So, we have challenges inside the government. We have challenges with, some of the hardest geopolitical challenges that presidents face. But ultimately, it is an issue of doing the work, showing up, and being a steady hand as opposed to the erratic stuff we're getting from the Republicans.
But when it comes to this issue in particular of what's happening in Gaza, the loss of Palestinian life. We have seen this resonating specifically with young voters, Pat, a demographic that the president is going to need to hold on to if he has any hopes of winning a second term. Do you think, with young voters in particular, that this issue is paramount, or is it something else like the economy, for example?
It's an important issue, but when you're president of the entire country and everything that's going on. This is an extremely important issue. The economy is an important issue. Student loans are an important issue. All of these things are extremely important. The contrast here is, again, with somebody like Donald Trump, whose leadership and statements on these things are frankly frequently very disgusting and I think scare people a lot. So you've seen Donald Trump almost deliberately jettison whole portions of the Republican Party, saying he doesn't need Nikki Haley supporters, he doesn't need anybody who isn't automatically loyal to him. And I think that right there is absolutely the wrong strategy to get elected president. But that's what you see Donald Trump doing, as opposed with Joe Biden, who is working to make the country better.
Well, you raise former President Trump. Of course, there was some news over the weekend, or at least a dialogue over the weekend, about something that Trump had reposted on True Social. It was a video of basically traffic that included a pickup truck, which emblazoned on the back of the truck was an image of the President Biden, hogtied, laying on his side in the bed. Of course, the Biden campaign was very quick to seize on that, talking about how this was essentially another example of Trump encouraging political violence, whereas the Trump campaign alluded to the fact that Democrats are making a very big deal of this at the same time that they're weaponizing the Justice Department, in their words, against him. Should the Biden campaign be reacting to each and everything that we see from President Trump on social media, or everything he says in a press conference, or is it best to let some things go? What should the strategy be here in dealing with who you're going to be up against in the general election?
Well, this is the dilemma, right? You either let it go, and then what does he do? He pushes it further. He pushes it further. Or, you call it out every time, and then you're playing on his playing field. Honestly, the real answer here is that Donald Trump oversaw political violence against the United States of America. Like, this is who the guy is. This is what he's done. It's what he's going to do. And that is a very important part of the message overall. So look, he's not taking us off message by promoting political violence. That is something that people need to know about, something they need to remember, that this is a guy. We had a long history of peaceful transitions of power in this country until Donald Trump came into office. So we got to talk about it. You can't just let this stuff go. If you do let it go, he'll take it further. And who knows, people could get hurt.
Well, Pat, and we know President Biden has put a lot of focus into contrasting himself with President Trump, be it for questions around political violence or the state of democracy. But theoretically, he could also need to contrast himself with others, including RFK Jr., for example, potentially a no labels ticket if we ever get the announcement of who actually is going to be on it. Does more effort need to go into acknowledging those potential third-party threats and trying to counter them?
Yeah, well, at my organization, American Bridge 21st Century, a big part of what we do is opposition research on candidates. And somebody like RFK, it's actually kind of interesting. The less people know about him, the better he does. If they just know the last name Kennedy, they go, oh, maybe this is kind of a reasonable guy. But the second they learn about his positions, his also flirting with political violence, he's flirted with a 15-week abortion ban, obviously his extreme anti-vaccine rhetoric, all these things, the second people learn about them, especially people who might otherwise be considering voting for Biden, they're like, I'm out of here. I'm not voting for this guy. So our job is really just to communicate. And there's no world where RFK runs for president without anybody learning about him. So we're happy to be here to tell the world. And no labels, look, we would be doing the same if they could figure out how to find a candidate. And if they do, I'll probably be saying the same thing.
Pat, we only have about a minute left, but we know that President Biden has a great deal of cash at his disposal. He raised more than $25 million in one night last week alongside former Presidents Biden and Clinton, more than $100 million on hand. Should some of that be spent specifically on countering or at least providing information on RFK or others rather than just on going after Trump?
Well, my organization, we're a super PAC. We're separate from Joe Biden's spending, but we've announced a $200 million effort to communicate with swing voters. Part of that is the RFK stuff. So it's definitely something that we're focusing on. I'm sure Joe Biden is aware that this is also a priority, but yeah, this is the kind of thing where you can run ahead of Donald Trump on money, and we're happy to do so, but ultimately, we're going to act like we're behind every single day until Election Day and not take a single vote for granted.
All right, Pat Dennis, always great to have you here on Balance of Power. Thank you so much for your time. Pat Dennis, of course, is the president over at American Bridge 21st Century. We're going to have much more coming up. Cast our eyes toward Baltimore, where tomorrow marks 1 week since the collapse of the Francis Scott Key Bridge. We'll take a look at what's happening with shipping on the East Coast as a result and the influence it could have on the economy. That's next on Balance of Power, right here on Bloomberg.
headquarters. I'm Charlie Pellet. 1221 on Wall Street. We have got the Dow, the S&P, NASDAQ, all in the red. NASDAQ 100 index holding on to gains, barely up by 5 points. Little change there. S&P right now down 17, decline of 0.3%. Dow Industrials down 273, down 0.7%. While the NASDAQ Composite Index is now down 12 for NASDAQ. That is a drop of just under 0.1%. Stocks erased earlier gains after solid factory data this morning reinforced speculation the Fed will be in no rush to cut rates. 10-year yield 4.32% with a 2-year 4.71%. Spot gold is trading higher by $11.30 the ounce, up 0.5%. $22.41 right now on spot gold, while West Texas Intermediate crude up 1.4%, $84.29 a barrel on WTI. Tesla may be heading for a gloomy milestone as waning demand for electric vehicles and elevated interest rates take a toll on sales. Analysts have rapidly lowered their projections for this week's deliveries report as the quarter came to a close. Today, Tesla shares, they are trading lower. Tesla right now down by 2%. Again, recapping stocks lower with the S&P lower by 0.3%. I'm Charlie Pellet. Balance of Power continues. Once again, here's your host, Kaylee Lines.
All right, Charlie Pellet in New York, thank you so much. Welcome back to Balance of Power, where we are broadcasting live from Washington. And just north of us in Baltimore, they're getting ready to mark 1 week since the collapse of the Francis Scott Key Bridge after it collided with a cargo ship, the Dolly. That happened, of course, last Tuesday. And right now, Baltimore Port and Harbor remains closed with no real timeline to reopen. The debris, of course, from this accident is continuing to keep the waterway blocked. And as a result, the nation's 17th largest port by cargo, the biggest one for handling autos and responsible for a very large chunk of U.S. coal exports, is still closed indefinitely. That means other East Coast ports like South and Norfolk, Northup in New York are having to absorb a lot of those cargoes that have to be diverted from Baltimore. And on that note, we want to turn now to Lee Glasgow, who is Bloomberg Intelligence Transportation and Logistics Senior Analyst. Of course, he's been following this very closely. Lee, thank you so much for joining us. Just what exactly is happening elsewhere on the eastern seaboard right now as a result of Baltimore being inoperable in terms of the port?
Yeah, what we're seeing is that, this is not a major blow to supply chains, and this is proving that, supply chains can be somewhat resilient. You're going to see freight that might have been heading to these ports, find alternative ports to go to. If you're talking about, on the auto side or ag or construction machinery equipment, that might go out to Philadelphia and the Port of New Jersey. For coal, it might head out to the Port of Norfolk. Well, the reality is that, they are going to clean up the channel. It could take 4 to 6 weeks for that to happen. And once that happens, freight's going to start moving again in and out of the Port of Baltimore. This, we view as a kind of a short-term hiccup for the companies that we follow. It's just going to increase volatility for them and maybe make, the second quarter not as strong as some people originally thought. But some of that freight just might be moved into the third quarter.
Okay, so I get in 4 to 6 weeks, things may be easier for the actual waterborne cargo, but it's also worth noting it's not just the harbor and the channel that needed to be cleared. It's a bridge that is going to need to be rebuilt, and that could take much longer. How much of an issue is it for actual ground transit, for some of these freight distribution channels? Because we know a lot of commercial goods were going over this bridge, the Key Bridge, each and every day. Just how much potentially could there be ramification actually on the ground, not on the water?
Right. So what you're going to see is, capacity. So the reality is your first point is it could take up to 4 years to rebuild the bridge. So that's an issue. And in that time, you're going to see, let's call it trucks, taking a longer route than they originally did, which will, eat up excess capacity, which net's a good thing for the trucking industry, because the trucking industry right now is operating at, very low rates. And, you need kind of a new equilibrium to come up for rates to increase. It's really not going to impact the flow of goods. It's probably going to more impact how long it takes to move those goods. Near term, we're seeing flatbed rates. Those are, if you see them on the highway, those are the trucks with the long beds behind it, and you're seeing those rates pop up because probably what's happening is a lot of ag or construction equipment are starting to get on those kind of flatbed trucks headed to other ports that were maybe originally sitting at the Port of Baltimore.
So just on this point of prices, Lee, you do expect that freight rates are going to go up. Will that be something longer term, or is that just a near-term impact that will then normalize? I'm just trying to think through the potential inflationary force here.
So on the trucking side, you could see a near-term pop in certain rates, and probably more on the specialized and commercial and flatbed rates. Not so much the dry van rates or refrigerator rates. Dry van rates are a typical trailer that you see behind a truck. A reefer rate is a temperature-controlled trailer, so a refrigerator. Probably not going to see much movement in those from this, but you might see a short-term knee-jerk reaction from the flatbed market. And again, those markets were pretty much depressed, so any increase in demand will probably have a large snapback in pricing, which is kind of what we're seeing. From an inflationary standpoint, I don't think it has the staying power. I hate to say transitory, but it could be just transitory in the next couple of weeks that we see.
Oh, a dangerous word. All right, Lee Klaskow, Bloomberg Intelligence Transportation and Logistics Senior Analyst. Thank you so much for joining us. And now with more on the inflationary impact, potentially transitory it may be, let's bring in Michael McKee, Bloomberg's international economics and policy correspondent, who is joining us from New York. Mike, should we just be looking through this issue in Baltimore, or is this something that is likely to actually show up in economic data moving forward?
Well, that's two different questions. If you don't live in Baltimore, you can look through it, basically, because it isn't really going to add that much in terms of cost to goods at their final stage when they go to customers. It will increase some transportation costs, but transportation is not a huge part, basically, of what the selling cost for goods is. So it shouldn't be a huge issue. However, the rebuilding, if they're going to spend $2 billion, that'll show up in construction, and it will show up in GDP at some point. But basically, that's what happens with all natural disasters, is you get something destroyed, and then all the money comes in to rebuild it, and that shows up actually as a gain. Now, we're talking just money here. We're not talking about the lives lost or things like that.
Yeah, of course, this was a human tragedy first and foremost, and I guess we'll see if it does indeed have an economic influence down the line. But let's talk about the data we've gotten already, Mike, because, of course, on Friday when markets were closed, the Fed's preferred inflation gauge, that core PCE deflator, came in. We heard from Chairman Powell very quickly thereafter, basically saying it was in line with his expectation. What's the good and what's the bad for the Fed in terms of the data we've gotten, not just Friday, but today as well with that ISM manufacturing print?
Well, definitely the ISM was good news. On Friday, the good news of the PCE report was twofold. One, that spending was relatively high still, and that suggests consumers aren't giving up and the economy has more strength, which is what Jay Powell was touting in his remarks. And the other good news is that inflation is still going down. Now, the bad side of that is it's going down at a much slower pace in recent months. And so that's why the Fed thinks it isn't ready yet to move forward with rate cuts, because they aren't sure that this is going to continue. And with people spending money the way they are, you get the possibility of inflation reaccelerating, which we saw today in the ISM numbers. The headline number goes positive for the first time since September of 2022, which is good news, but prices paid rises as well to 55.8. Right. So that suggests maybe there's some inflation out there.
Yeah, well, and as a result, we're seeing bond yields climbing. We're up 13 basis points on the 10-year to 4.33, essentially, and swaps are now pricing in a less than 50% chance of a rate cut in June. And perhaps manufacturing data is another example of this, Mike, as we're seeing an expansion for the first time since 2022. Where is the evidence that this economy needs a rate cut, that something bad is happening that would suggest easing of policy needs to happen?
That might have been good for your Easter egg hunt yesterday. See if you can find the evidence. There isn't a lot of evidence at this point that we absolutely need to cut rates, which was the point Jay Powell was making on Friday, Christopher Waller was making last Wednesday. There's no rush because the economy is, at this point, in pretty good shape. Today, the Atlanta Fed GDP Now number was raised to 2.8% for the first quarter from 2.3%. So over the last couple of days, we've gotten additional strength, signs of strength in the economy. So is the Fed's rate right now hurting growth? Doesn't really appear to be. So there doesn't seem to be any kind of clear reason to cut rates very quickly. Now, Powell did mention if we saw unemployment rise, that could change their mind. We'll find out on Friday.
Well, yeah, jobs report on Friday, Mike, a lot to look forward to. Is that actually, though, going to make a real difference to what they decide when they meet April 30th?
Well, interestingly enough, it will be the only jobs report we get between now and then because the Fed meets on May 1st. So whatever they get out of this and plus the weekly jobless claims and things like that will be their impression of the labor market. So in that sense, it is important. But given that we're not expecting anything until June or July in terms of rate cuts anyway, it isn't going to change that view, I don't think, unless there were a really big rise in the unemployment rate this Friday. What we've seen is people moving to July from June, and that just means that we're going to be out, higher for longer as the data keeps coming in strong.
All right, Michael McKee, looking forward to your coverage, of course, of the jobs report on Friday and everything in between. He, of course, is our international economics and policy correspondent. Now let's check on world and national news. Amy Morris has that in the 99.1 newsroom here in Washington. Hey, Amy.
Hey, Kaylee, we are learning more help may be on the way to Baltimore. Workers are still dismantling the collapsed Francis Scott Key Bridge, just as you were discussing. A fourth Navy crane is set to arrive to help clear the massive wreckage. Demolition crews are working now around the clock, lifting portions of the ruined Francis Scott Key Bridge out of the water. Highly trained teams are now lifting the wreckage from 2 crane barges, and they're cutting up the enormous snarl of steel trusses into smaller sections for removal. President Biden is expected to visit Baltimore this week to see the bridge clearing operation firsthand. The Department of Transportation is providing $60 million in immediate funding after last week's bridge collapse, the first portion of billions of dollars in expected costs to rebuild the bridge and reopen the Port of Baltimore. This is just the beginning. We get more from Bloomberg's Laura Davison.
So the administration has pledged to fund the bridge package. However, the bulk of the money will need to come from Congress. Biden has already approved small amounts of money in the millions, but this is going to cost somewhere closer to $2 billion. So Congress will have to fund that and pass that bill.
Bloomberg's Laura Davison tells us that Congress is out this week, and they were out last week when the bridge collapsed. This is all at the top of the agenda when they return on April 9th. Officials are also opening alternate channels to the Port of Baltimore. The 2 auxiliary channels will be used by response vessels, commercially essential ships, and those participating in salvage efforts. Coast Guard Captain David O'Connell says that they need to get a better idea of how deep the main channel is as they work on creating those alternate channels. And 40,000 visitors at the White House today, including military and veteran families, caregivers, and survivors for this year's 144th annual White House Easter egg roll. Global news 24 hours a day whenever you want it with Bloomberg News Now. This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. We are off session lows, but still a lot of red on the screen. The Dow, the S&P, NASDAQ all declining. 13-point drop right now in the S&P at 5240, lower by 0.3%. The Dow down 260, a decline there of 0.7%. The NASDAQ Composite Index now little change, down by 1 point. 10-year at 4.32% with a 2-year that's yielding 4.70%. Spot gold is trading higher by $12.50 the ounce. Gold at $22.42 right now, up 0.6%, while West Texas Intermediate crude oil is up 1.5%. WTI now at $84.47 a barrel. Solid U.S. factory data is reinforcing speculation the Fed will be in no rush to cut rates. We got surprising positive news on manufacturing, and with that story, here's Bloomberg's Vinny Del Giudice.
Factory activity expanded in March for the first time since September 2022 on a sharp rebound in orders and output. That's the latest from the Institute for Supply Management, and it tops Wall Street estimates by a wide margin. Firmer factory orders point to healthy consumer demand and healthy business investment. That suggests firms have made strides evening inventories with sales. Vinny Del Giudice, Bloomberg Radio.
And again, 10-year now yielding 4.32%. The private prison operator Geo Group is tapping the debt market, including selling a $400 million leverage loan in a refinancing move that follows in the footsteps of a competitor who did just the same 2 weeks ago. Private prison operators like Geo Group have had a hard time accessing capital markets in recent years as investors shun the business due to environmental, social, and governance concerns. Shares right now of Geo Group, they're up 2.1%. Again, recapping stocks lower. 13-point drop right now in the S&P 500 index. The S&P lower by 0.3%. NASDAQ is now unchanged. Balance of power continues. Back we go to Washington. And once again, here she is, your host, Kaylee Lines.
All right, Charlie Pellet, thank you so much. A happy Monday to you. And from those of us here in Washington, a happy White House Easter egg roll day today. It might be a little ringy for this event on the South Lawn, but some 40,000 people are still going to show up for this annual tradition in celebration of yesterday's Easter holiday. But yesterday, March 31st, also happened to be Transgender Day of Visibility.